this hearing of the House of Representatives Standing Committee on Economics for the review of Australia's 4 major banks. Today, the committee will hear from the Commonwealth Bank of Australia and ANZ. And tomorrow, we'll hear from the other 2 major banks. Westpac. And tomorrow, we'll hear from National Australia Bank and ANZ. Slight misspeak. I welcome representatives of all 4 major banks, as well as members of the public and media in the room and watching on webcast. These annual public hearings have played an important role in public scrutiny of the 4 major banks since the Hayne Royal Commission 5 years ago. It is a privileged role and one that this committee takes seriously. In the past hearings, we've looked at interest rates, competition between the major banks, bank profit margins, the fair treatment of customers, bank closures, scams and many other important issues. This year's hearings are timely, with many economists predicting Australia is approaching an inflection point in monetary policy and noting that there have been some highly publicised movements on mortgage rates by the banks in recent days. We've also seen the publication this year of 2 scathing ASIC reports on the banks, one that shone light on seriously inadequate processes for supporting customers in financial hardship, and another that found banks knowingly kept some of the poorest and most vulnerable Australians on high-fee accounts. These hearings are also timely in light of ASIC's suspicions of extraordinary conduct, potentially by some ANZ bond traders, and the committee looks forward to hearing from ANZ tomorrow afternoon. The banks play a particularly important role in our economy, but particularly at a point like the one we're at the moment, where monetary policy is playing such a critical role in the trajectory of the overarching economy. In accordance with the committee's resolution of 9 August 2022, this hearing will be broadcast on the Parliament's website, and the proof and official transcripts of the proceedings will be published on the website. While I appreciate there is significant public interest in this hearing, I remind all those present that these are parliamentary proceedings which must be conducted with decorum and respect. Those present here today are advised that filming and recording by the media are permitted during the hearing. I remind members of the media who may be present or listening, however, of the need to report the committee's proceedings fairly and accurately. Media present are also reminded to conduct themselves in a manner that does not interfere with proceedings, and they must not encroach into the committee's work area or film or photograph the documents or devices of committee members, witnesses or others. So first up, I welcome representatives of the Commonwealth Bank of Australia. For the benefit of Hansard, could I please ask that you each state your full name and the capacity in which you appear before the committee?
Thank you. Good morning. Matthew Peter Comyn, Chief Executive Officer and Managing Director of the Commonwealth Bank of Australia.
Great.
Good morning. Monique McLeod, Group Executive of Marketing and Corporate Affairs for the Commonwealth Bank of Australia.
Well, thank you both for appearing. I remind you that although the committee does not require you to give evidence under oath, the hearings are legal proceedings of the Parliament and warrant the same respect as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of the Parliament. I also remind any members on video or teleconference to respect and adhere to the requirement to mute their microphone unless given the call to ensure that all questions and responses are heard. Mr Comyn, I invite you to make an opening statement if you wish.
Thank you very much, Chair. Good morning, and thank you for the opportunity to appear here again today. We welcome and look forward to the discussion this morning. Australia's economy is fundamentally sound, despite challenges and global uncertainty. Households and businesses have experienced extreme shocks in recent years: lockdowns, a demand surge, inflation and rapid interest rate rises. Many of our customers are finding it difficult to deal with the higher cost of living. In the past year, we have deliberately and proactively contacted customers and have initiated 132,000 tailored payment arrangements to those most in need. As you know, the effect of monetary policy is unevenly felt across the country, with different experiences for borrowers and depositors. Our insights tell us that, in aggregate, households are spending more on essentials and are cutting back on discretionary spend. We can also see that savings are being depleted, particularly by working families. Younger Australians, who tend to have lower incomes and smaller savings buffers, are the most sensitive to these changes in prices. Those aged 35 to 44 have the highest share of mortgage balances and are most exposed to higher interest rates. In providing this support to customers, we have sought to engage them through their preferred channels, many through NetBank or the CommBank app, but others through more traditional channels like our contact centres and branches. We're proud to maintain Australia's largest branch network and more than twice as many ATMs as any other bank. CBA is committed to keeping all of our regional branches open until at least the end of 2026. Last financial year, we invested over $80 million to improve our branches and $800 million to operate our branch and ATM network. We also distribute around $4 billion in cash each month through our network and the country. Cash is important for many customers, and we're committed to ensuring a reliable and efficient distribution of cash to communities. As part of that commitment, you may have heard that the ABA, major banks and major retailers have reached an agreement with Armaguard to provide a 12-month financial contribution towards its cash in transit business. The agreement will see Armaguard receive approximately $50 million in additional financial assistance over the next 12 months, subject to meeting monthly key performance indicators and other conditions. Our branch and ATM network is also complemented by our partnership with Australia Post, which dates back more than a century and is in place until at least 2032. We will continue to constructively engage across industry and government to find a long-term, sustainable solution to maintain cash and physical services in communities. And while sustaining these services is important, these challenges have been brought about by rapid changes in the way customers engage with their bank and the way they pay for goods and services. Whatever means of payment is used, there is a cost involved, whether that be the physical cost of moving and counting cash or the investment required in building the new payments platform. Some of those costs are more visible to consumers than others, and some of those costs are more fairly distributed than others. Recently released research by Boston Consulting compares the direct and indirect cost of cash versus card payments in Australia. According to this research, cash payments cost merchants approximately 3.9% to accept, which is more than double the cost of card payments. Consumers do not expect to be surcharged for using cash, as the cost of cash is embedded in the cost of the goods or services. Yet they are frequently surcharged for using a debit or credit card. The RBA will shortly commence a review into these matters, and I welcome the focus on this important area. Payments technology moves quickly, and it is critical that the regulatory environment moves with it. Some legislation governing payments has been untouched for 30 years. To this end, it is also critical that Australia passes amendments to the Payment System Regulation Act, which will allow the RBA to adequately monitor the payments ecosystem and intervene where needed. These changes are currently before Parliament, and I hope that all parties will work together to ensure that this critical legislation is passed as soon as possible. Finally, in an increasingly digital environment, keeping our customers and the broader community safe from fraud, scams, cyber threats and financial crime is a significant priority for the entire banking industry. Criminal activity focused in these areas has escalated since COVID. Last financial year, we spent more than $800 million to prevent, detect and disrupt these crimes. We have over 4,000 people working full-time across these areas, and it is now one of the largest areas of operational activity within the Commonwealth Bank. We were able to cut scam losses to customers by more than 50% in the last financial year. We did this through several market-first innovations, improved controls, increased alerts to customers and continued public education and awareness. We've also shared our technology and intelligence with others. Having made progress across the industry to reduce scam losses, the challenge now is to continue to drive them down. It is simply not possible for the banks alone to limit scam losses across the community. Broadly, there are 4 steps necessary to build a resilient anti-scams ecosystem in Australia. Firstly, to introduce mandatory codes to require banks, telcos, social media companies and others to meet a minimum set of standards. Secondly, require key players to share information. In June, we announced that we were the first bank to share information into a new anti-scam intelligence loop to share data about scam activity with banks, digital platforms and telcos. Thirdly, as a response to this intelligence, there should be obligations to act quickly to lock bank accounts, to block phone numbers, and to remove scam ads and accounts on social media. And finally, there should be a proportionate liability scheme which says to all of these organisations, including, of course, us, that if you do not meet your obligations, then you will be required to reimburse customer losses. This liability scheme should be simple, efficient and fair for customers, with a single front door to access and resolve disputes. Across scams, fraud, cybersecurity and financial crime prevention, there are many opportunities for the private sector and the government to work together. To this end, we welcome the government's focus on expanding the anti-money laundering and counter-terrorism financing regime to capture Tranche 2 entities. These reforms will strengthen Australia's approach, our standing internationally, and will help to protect the community from AML/CTF risks. Thank you again for the opportunity to appear today. We remain deeply committed to Australia's success, and we hope to provide the committee with some useful insights this morning.
Thanks for your opening statement. So look, I'll start with some questions, and then we've got almost a full complement today, so we'll then work through all of the other members, some of whom are online. I just wanted to go to some questions around the state of the economy. The banks, in one sense, are able to see more up-to-date but also more granular data than, in fact, government agencies. So my understanding is that banks are working more closely with the RBA and Treasury and government than ever before, and certainly than would have been the case 10 or 20 years ago, which is a good thing. But in light of that, I'm just interested in, for the benefit of this committee and Parliament, just a few questions around your understanding of the detailed trends in what you're seeing. So you talked about the fact that there's been a differential in the trend between discretionary and non-discretionary spending. Can you just drill down into that a little? Is the gap between the two growing over time as households experience higher interest rates for longer periods of time?
Yes, and so firstly, yes, we share and I think work very constructively with both the Reserve Bank, key reporting agencies and Treasury. We've just finished our full year results. We presented those on the 14th of August. We spent quite a bit of time talking about that on the day of the results to try to inform both our investors and the broader market about exactly what we were seeing. And I can take you to the slides if it's helpful at another point. But what we were showing is changes in spending behaviour, as one example, across different age cohorts and across different time periods. And what you can see, and we see and hear it clearly and directly, is that obviously higher prices and inflation, which is a very challenging issue for many households, is continuing to erode both savings. And then if you look at spending across different cohorts, a larger proportion, particularly for younger cohorts, is now being forced into essential, and they're reducing their discretionary spend. And then entirely consistently with, I know, the Governor Bullock's comments, inflation have a disproportionate impact on lower income. Mm-hmm. And we can see that in some of the data that we've presented on both spending and on saving. There's a faster depletion. I think it's approximately, I could refer to the slide, but I know from a savings perspective, in the 25 to 34-year-old age cohort, it's down sort of 11%, which is basically double the rest of the cohort if you look at the lower quartile of income. So we see that consistently, and that's, to be expected. There's generally younger people have less financial savings, less buffers, less resilience. The vast proportion of household debt, particularly in the form of mortgages, is across the 35 to 44-year-old age group. And so they're bearing the effects of monetary policy and the cash rate. But quite clearly and simply, even those that do not have debt, you can see the impact of inflation, and why it is critical to get inflation back into a normal range, because it has a very deleterious effect across all aspects of both households and businesses, but disproportionately impacts lower income.
Now, I'll just take a step back and look, certainly not asking you to get into detailed commentary on all the various government programs out there, but simply to make the observation that government has tried to lean in to assist some cohorts in a way that is responsibly calibrated in light of the fact that we need to see inflation keep coming down, but that was motivated in part by the fact that we are seeing uneven impacts. And it's really that point I just wanted to kind of get to reiterate to make sure that I'm getting the right understanding of your observations, which is that the impacts of monetary policy and indeed of inflation and the broader economic situation is falling unevenly on households based upon a range of criteria such as their age, their income, but also how indebted they are. So, you know, all these different, this matrix of different characteristics does mean that households are being affected very differentially.
Absolutely, and look, I'll let Monique speak to some of the sort of customer insights, and look, frankly, it would be the same insights that the government would be seeing and hearing. It's the same insights that the Reserve Bank is seeing and hearing. The pressure has continued to build over the course of this calendar year. We can see that, you know, very directly and sharply, and you know, I have. You know, a lot of understanding and appreciate the need to be able to try to provide some targeted support and assistance for those that are bearing the brunt of it. There is no question in my mind that consumers and citizens are expecting that support, and there's, you know, a fair degree of anxiety beyond the uncertainty that we were seeing. But Mon, maybe do you want to expand on that?
Yeah. Thank you, Matt. As Matt mentioned, we're talking to customers every day and looking at the data, but we also want to take a step back and just understand how they're feeling from a sentiment perspective and what the real pressures are to see how we can lean in and help. And certainly over the last 6 months in particular, we've seen a more steep decline in how they're feeling. And, you know, there's a real lack of confidence because of the time frame of which the pressure has gone on. So as you can imagine, in the early days, many customers are putting their own strategies in place to deal with the rising costs, but now they're feeling a little bit more pessimistic as that's obviously gone on for a little bit longer than they would have expected. They would describe it as making, you know, real sacrifices in how they're managing their day-to-day, and yes, that it goes to discretionary, but also to essentials. And so what we really see and hear is, you know, the ways that we can make access to help easier for them and more readily available. And there's a real range of what that looks like. So, you know, on one end, for customers who are really genuinely in hardship and have real needs, that is about actually making sure that we have more proactive contact, you know, early outreach, making it simpler to have a conversation about hardship. And as Matt mentioned in his opening, we've put in place 132,000 payment arrangements across the course of the year. The second thing that we see and hear frequently is customers are managing, but then there'll be something that will throw them an unexpected bill or something that arises, an illness, etc. So they just need some form of access to, you know, some more immediate help. And so in that instance, we've been able to make available to 6 million customers more of a safety net where they can access up to $2,000 relatively simply. And then thirdly, I'd say for a lot of people, it's actually a time when they've become more engaged with their own financial situation than they ever have been before. So what we've also really found is there's just significant desire to engage more heavily in the tools that we have available. We have over 3 million customers interacting with our money management tools, so budget trackers, spend trackers, cash flow tools. And so to that end, we've put significant effort this year behind making content available. So whether it's tools or content, we have a personal finance expert by the name of Jess Irvine, who has had a program across the last year where she's just been putting a lot of helpful information out there for customers through all of the channels around tips to manage your money better. So we've really seen an uptick in that space, as I've mentioned, because customers just have been really seeking additional help across the board.
Thank you for that. So, look, I just wanted to turn now to profits. Mm-hmm. So you recently announced annual profits. Mm-hmm. Can you just remind me the figure?
It's approximately $9.8 billion, which is about 2% down on a cash basis year on year.
And what does that look like in terms of return on equity?
It's approximately 13.6%.
And what's the trend in ROE over the last, say, 10 years?
Substantially down. Our return on equity of certainly going back a decade or more. It has certainly been lower than it currently is. Not sure what the lowest would have been, probably around 11% or so. And look, there's a number of reasons for that. So one driving factor is financial institutions, including the Commonwealth Bank, are holding substantially more capital. But in aggregate, I think that's a very good thing. I think the financial stability and resilience of the Australian banking system is serving the country well, particularly in difficult times. It's one of the reasons we were able to provide so much support during COVID. Having a strong, reliable banking system is, I think, incredibly important, obviously one that serves customers well.
So when you say you're holding more capital, is that changes over the last decade in relation to regulatory obligations?
That's right. It was following
like
the
post-GFC changes?
Yeah, the inquiry that David Murray led, the FSI inquiry, which principally increased the mortgage risk weights, which led all of the banks. I think we raised about $5 billion in capital. That would have been in about 2015. So that's been a major driver. There's a number of other capital changes on a global basis, which I suspect the committee won't be interested in. But capital levels have been increased from that point, but also finalised. And international comparability is an important aspect. Clearly, ongoing competition also, and where you are in the cycle has a big driver on return on equity. If banks are not in a strong position, particularly when credit losses are low, that augurs very poorly for the outlook of the economy and the essential role. And perhaps one way to illustrate that this is true in many markets, but perhaps one of the most extreme would be one of the European markets like Spain, where it took more than a decade for the banks there to be able to generate a return above their cost of capital, which simply means they are unable to and therefore do not lend to provide and facilitate economic growth, which you can imagine, a small impact on sort of GDP and economic growth over a long period makes a very big difference to our commitment to continuously improve the economic conditions for Australians. And so, from our perspective, there's clearly a range of different return hurdles and also outcomes that are achieved by institutions. One of the smaller banks announced their results in the last couple of weeks, and I think their return was about 6.5%, which effectively means an investor who would be asked to put money in to any company that's returning less than their cost of capital is, by definition, destroying some proportion of the value that they're putting into it. So, at least from our view, would very clearly be it's important that banks are above their cost of capital and have a reasonable return on equity. And of course, that's something that we need to strike the balance appropriately every day and be there to support customers as we are now, and to not impose any obligations more broadly by significant financial institutions ever being in a real position of stress.
Look, I might follow up with you, but all four banks with some questions on notice on some of these financial metrics. But look, I'm interested in the extent to which there are also cyclical factors. The banks always claim there's ferocious competition, and we can debate back and forth, and certainly in the general community that there at times isn't a feeling of that. But when that issue comes up, banks will often point to the fact that there are. Ms. Lawrence, I think you're on speaker. Well, thank you. But look, one of the issues that comes up is churn rates, which is an objectively measurable reflection, at least to some degree, of competition. So I'm just interested in the extent to which that trend post-GFC in return on equity it's whether the extent to which it's possible to break it down into regulatory changes on the capital holding side versus what's happening in terms of consumer engagement and customer churn.
It certainly would be. I don't really perhaps come back to churn itself. There is intense competition. There's been extremely well documented, particularly in the last couple of years, particularly in mortgages. I mean, it's a matter of fact that at various points in time, mortgage origination was below the cost of capital, which is not a good and sustainable model. And I mean, just to illustrate, why is that important? One way to think about a bank is that when we lend $500,000, let's say, for a mortgage, we effectively have to set aside $15,000 of capital. That's sort of practically how capital is used. We set aside money for provisions, which is expected losses, and we set aside capital for unexpected losses. So approximately $500,000 mortgage is about $15,000 of capital. Now, if that individual mortgage was to, say, go to 90-day arrears, which we published that's at 65 or 0.65 of 1%, that capital that you have to set aside goes from $15,000 to approximately $100,000. So you can see, before a customer's even defaulted, how capital can deplete. And this is what talks to your cyclical factors, which is why economic growth, economic stability, low unemployment are the most important aspects in terms of sort of driving the cyclicality of returns. It would be a matter of fact that the levels of both mortgage competition, net interest margin compression are some of the largest absolute moves that we've seen in multiple decades. Now, competition is a great thing for customers, and one ancillary benefit of that is the full effect of the cash rate increases has not been passed on to mortgage borrowers. So we can set all of that out in whatever detail you would like.
Yeah, no. Look, I'll come back with a reasonable number of questions in a template form. Look, I just wanted to get to the issue of bonuses. Now, my understanding is that Commonwealth Bank was the first to move in allowing bonuses to exceed 50%. I think, indeed, in some contexts, for it to go up to 80%. So, just to make it concrete, a manager on a $200,000 salary in some contexts might then be able to earn a maximum of $360,000 rather than $300,000. So this is, well, firstly, I'm just interested in who within the bank would this extension of the bonus arrangements apply to?
It applies to what we would describe as proprietary lenders, mortgage lenders, so customers who serve personal bankers or personal lenders who serve personal customers to meet their home loan or mortgage needs.
But is it also going to apply to staff that are trying to originate, that are trying to seek out new loans?
It's that same category and population, and if it's helpful, perhaps I can give you a little bit of context. One of the many things that was part of Stephen Sedgwick's review of remuneration practices across, it principally focused on retail banking, was a number of changes to the way people's performance has been measured and the way the remuneration structures. There were, by recollection, 2 specific recommendations to the mortgage broking industry that were never implemented. The rest of the recommendations were implemented. Some of those recommendations applied to proprietary lenders, in this case, restricting the maximum that you could be paid as a variable, or let's say, use the words to simplify, a bonus as a proportion of your fixed pay. So if I'm earning $100,000, the maximum could be 50%, $50,000. Now, we have considered this issue carefully and over a significant period of time. I guess what I'd remind the committee is, if you're a proprietary lender in the mortgage in the Commonwealth Bank, you have an extensive oversight and monitoring, which applies to what we call a risk gate, which means if you fail, you get nothing. There are a number of other criteria that, such as values and behaviours. Then the scorecard that determines a bonus, in this case, is equally weighted 3 ways. Customer, so it's an NPS or an advocacy. The second is business outcomes, which is effectively lending to customers. And the third is around key role activities. So there are a number of controls to be able to monitor that. So we have lenders on a fixed pay, A small proportion would then qualify for an increase from versus 50% of their fixed pay to 80%. And if I can just make the comparison, and I'm certainly not alleging that this is a problem per se in the mortgage broking industry, but if you think we have 1,800 home lenders, there are approximately 20,000 mortgage brokers. Mortgage brokers, very successfully since 1995, have grown to be about 72% of mortgage origination. There is, as a matter of fact, no balanced scorecard. There is no fixed pay. They are entirely remunerated based on the number of loans that they sell. Now, I'm sure this has been extensively reviewed. There's, of course, their own regulatory obligations and things that have come in from a best interest duty perspective. But we felt that we were putting ourselves at a significant competitive disadvantage. We thought it was unfair, the remuneration practices that we were limiting our people to, and we see it still as a much lower risk channel than the mortgage broking channel.
So, look, there is this issue of your staff versus mortgage brokers, and that's something we can explore with regulators. But look, I think there's also the broader issue of practices, in a sense, creeping back into the big four banks. Now, I think you were the first to move here, but it's being matched by others. I do draw attention to the fact that not long after this move was announced, a spokesperson for ASIC said this change is disappointing. There is ample evidence that variable remuneration arrangements and incentive selling result in poor outcomes for consumers. Around the same time, Professor Sheedy at Macquarie University, I think it was, said that the risk is people become short-term focused and do dodgy stuff like exploiting unsophisticated customers. I mean, the concern here is that the Sedgwick Review set a line. It was a line
that was never fully implemented.
Sure, but it was, in response to the Royal Commission, and
it was fully implemented
years
by
down
the
the
banks.
track, we're now seeing you take actions to move beyond that line, and it seems quite likely that all others will follow. I mean, there, as you point to in your original answer, I mean, there are tricky issues of culture here, and I mean, you point to the fact that there are internal controls, but you can understand how parliamentarians and regulators looking from the outside worry about practices starting to creep in that led to a lot of problems
I can
back when the Royal Commission itself was held.
I can certainly understand it, and I can understand, and I'm aware of ASIC's comments, and of course, as they've mentioned, we've met privately with them. I can understand the concern. I think, and I certainly can't speak for other financial institutions, presumably they're making their own decisions independently of ours, but they must be alert to the same issues that we are seeing, which I guess the broader response.
But they're also
would be,
having to respond to what you're doing.
Well, but I mean, ultimately, we've got to make the best decisions in the interest of the Commonwealth Bank. We believe that these risks can be controlled. And alongside that, whilst I certainly acknowledge the concern, and it's a valid concern, and it's we had an extensive dialogue with a number of stakeholders, including our regulators, but it simply cannot be that there is an undue level of concern over, we're talking about a few hundred lenders versus the 20,000 mortgage brokers that don't have any of the controls that we're talking about in this regard. So I certainly acknowledge these concerns, but they must, on the same point, be dwarfed by concerns in other aspects of the industry. But ultimately, we recognise that it's not a decision we made lightly. We had extensive deliberations and engagement with the regulator. We felt that in the interests of both our customers and the broader market and the Commonwealth Bank, it was the right thing to do, and it's up to us to be able to control for any of those issues and risks. Culture is an important issue in any company, large and small, and so it's something that we will ultimately have to make sure we manage very closely.
So look, just a couple more questions. before I hand over to the Deputy Chair. Look, I just had some questions around regional bank closures and also the arrangements with Australia Post. So what kind of community consultation and/or social impact assessment is undertaken before a decision is made to close a regional or rural branch?
Well, at the moment, it's relatively straightforward because we made a commitment, was that 9 or 12 months ago?
June 2023.
June 2023, thank you, Mon, to not make any changes or closures to our regional footprint until at least 2026.
Before that commitment was made?
Well, I mean, broadly, and this is something that's been examined as part of the committee that was set up to look at that. And I know that there's been changes that have been agreed across the industry over the last couple of years, but broadly there's a consultation period. We can debate whether that's sort of sufficient. There's communications. I mean, the restriction or the closure of any branch, notwithstanding whether the vast majority of customers may be using those services digitally very effectively, any reduction in services, whether it's one customer from that branch, is a difficult decision and is certainly not a popular decision. We've thought that it's important. We were at the time the only bank that was prepared to make that commitment. One other bank has followed with that commitment. We're certainly very active in regional Australia. We think it's an extremely important part of both the economy and the fabric of the Australian community. We made the decision because we thought it was the right thing to do. We also hope that we'll win a disproportionate share of customers in those regional areas because one factor has been over time that as branches have closed, customers have not changed banks. And so, I mean, part of that is, well, if you value having the Commonwealth Bank in the regional area that we're in, showing us that support by banking with us would certainly be appreciated and frankly extends the duration by which it makes some economical sense to be able to deliver that. We're constantly, and more so than any other bank because of our scale and also the fact that we are both historically and currently the bank for all Australians. We have to deal with a much larger and more varied customer base. We're constantly trying to manage the most appropriate way to serve those customers. And in many of those areas, yes, they operate at a loss. It's not necessarily on a standalone basis economically viable, but we have to balance all of the aspects and obligations to the community, and we understand that.
I mean, I think the commitment to 2026 is a good support for a lot of regional and rural communities. But, I mean, you can imagine that by the time we get to 2026, a lot of those fundamental drivers will be still in play, if not more so.
Dr. Miller, in some of those areas, actually, we've seen a significant number of new customers move to us. So actually, it changes the economic viability and the decision that we may have otherwise made. Now, obviously, we'd like to see that in more areas, but I mean, we certainly have made that commitment. We will continue to engage. I mean, it's the longest notice in the history of Australian banking to give to regions about what our intention might be beyond that. We want to communicate clearly, and a number of mayors and local representatives in areas have been very helpful because, in effect, we're basically sharing with them what we're seeing. And so if that town or community can be part of that, then, obviously we'd prefer to be able to stay there in an economically viable position.
And if I could just add, Matt, the other thing that we're looking at doing is finding a slightly different model. So, for example, for a number of our branches now, we're serving customers face-to-face in the morning and then closing that in the afternoon and using that opportunity to serve the many customers that we deal with, either through phone or messaging. So we're also looking at additional ways such as that to make it more acceptable as well.
Yeah, no, I mean, that was a model which we, I think, explored during our competition hearings last year. And look, it'll be interesting to come back in 2026 if we're all still around and investigate what's happening in some of these areas. But look, last question before I hand over. Look, it's just this issue of Australia Post in the sense that it may be feasible in some areas for one or more banks to remain open indefinitely, but there is also a sense that when each individual bank makes its decision, individual big bank, and I should acknowledge that there are some regional communities where it might be customer-owned banks or others who are the present, so I do want to acknowledge that on the record. But it might be that each individual bank makes a decision based on its own calculations. Some kind of shared resource like Australia Post might in some communities be the only feasible way forward. I'm just interested, what are the, in broad terms, the arrangements with Australia Post? From your perspective, are they broadly workable? Are they having to adjust over time based on changing market conditions?
Yeah, and if it's helpful, perhaps I'll give a brief history and then I'm happy to expand in whatever detail you would like. We have a long-standing, I mentioned it in my opening, decades arrangement and engagement with Australia Post. The brief history, though, would be in 2019, Australia Post came to us and said, actually, we need greater financial support as part of being able to provide bank at post services. They furnished us with an external report. We thought that external report was reasonable, and we substantially increased the commitment. So the contribution works as follows. There's a community fee, and then there's a transactional. It's called a community representation fee. It was approximately $22 million. We pay about another $20 million in transactional fees. Now, this community representation fee is somewhat relevant because it was supposed to be precisely to pay for other services and upgrades within the Bank at Post network. Some of the things that, at least it would appear based on recent comments, are not where they need to be from Australia Post perspective. We entered into, I think at the time, a 5-year contract in approximately 2021.
And each bank had a separate arrangement?
Yes, and not all banks agreed. So I think 3 of the majors, 1 major has never been part of that. Many regionals as well. I can't speak to the individual motivations of the banks that haven't participated. We would be the largest contributor to Australia Post financially. Then in approximately at the end of 2021, us and Australia Post entered into an extended agreement. That is the subject, that agreement that was offered and accepted is the subject of what Australia Post is seeking to renegotiate, which we're certainly very open and have a very constructive relationship with them. It is somewhat unusual, and I think you would recognise that there wouldn't be many businesses in the electorates you represent that are able to seek a renegotiation of contract just because they don't like the conditions. From our perspective, it's hard to reconcile some of the numbers that have been presented. Our transactional volume is basically flat. Over that time, there'd be since December 2021, there would have been approximately 85 closures of branches. Obviously, a very small proportion of those would have been regional and none at the moment. But look, all that to say, we will continue to engage. We think they're an important part of the overall service proposition for many Australia Post outlets. It's an important source of revenue. I think Bank at Post represents about 8% of overall transactions within Australia Post. I think
so 8% of their transactions?
Of their transactions. I think what... And
what percent of your transactions?
Oh, tiny. I'd have to get you the exact number in terms of the total transactions.
Yeah.
And transactions.
No, I mean, given time, I can come back with a couple of questions.
Sure.
But look, it's interesting to get that context. Thank you. Look, I'll hand over to the Deputy Chair. Thank you for your appearance.
Thanks, Chair. Leave me wondering what a balanced scorecard for bonuses for politicians might look like, but it's another conversation. Can I refer back to just the round of media came out about 2 weeks ago, making some pretty strong suggestions around CBA's intentions for future funding in oil, gas, and mining operations. Look, I'll go to I guess the interesting part is the ABC article. It largely sort of references a press release from Market Forces without direct commentary from CBA. Mm-hmm. So maybe be an opportunity to talk about what that is, what your intentions are, if there are any changes, and noting I have read through as much as I could of the ENS policy statement. Fantastic way to get to sleep at night. There's a sort of lack of clarity you might expect from a document that has that level of corporate intent. But so if you could maybe just provide some guidance on where you're headed.
Sure, no, very happy to. Perhaps the climate report that we also published on the 14th of August, it's a bit more of a page turner than the framework itself. But you can be the ultimate judge of that. Look, as you said, we haven't contributed to those reports. We don't talk about client or any of that specific information, but we do an extensive amount of disclosure. But perhaps if it's helpful, maybe sort of like a broader framing, and then I'm happy to talk a little bit about our approach in some of these individual sectors. We, and I believe all of our stakeholders, have made commitments around net zero by 2050. We think alongside that, perhaps with primacy to that, we are committed to Australia's economic development, growth and performance. We have to hold both of those commitments at the same time. Neither of those can be mutually exclusive. We also believe, as part of those commitments that any large listed company needs to be prepared to make around Paris, things like the Net Zero Banking Alliance, we can't leave things into the 2040s. So effectively what we need to be able to do is set out what we're doing with our own operational emissions, which are small. I think we're a 90% reduction since 2014. But most of the interest in financial institutions globally is around Scope 3 financed emissions. So effectively the money that we're lending to our customers and their emissions profile. We've published now a number of individual sector glide paths. So I think we're up to now sort of 10. But in effect, we are proposing or publishing what our emissions intensity profiles will need to be by sector to be consistent with those broader obligations. And so we weigh up both of those considerations extremely carefully. What's in the best interests of Australia, our customers, our communities, and how do we, alongside that, make sure we honour the commitments that we've and all of our stakeholders have made and expect of us to get to net zero by 2050. I'm happy to speak to individual exposures in sectors if that's helpful.
Well, let's have a look at, I guess the one that's most interesting to me and probably has got the most attention is gas. And my direct concern would be, having read those, the media reports there, and from what I can take from there, there is a risk, there's an absolute risk that following that you will see a reduction in investment in gas in Australia. That by, if I'm using the line correctly, that only lending to companies that have a pathway or an emissions reduction target pathway, that they're the only people that you would lend to. And that obviously adds a cost to those companies, which means that some projects now will not be viable. So there's a direct pathway. And I'm not gas, I am mining background, so from a resources point of view, I'm going to make the point. When the cost increases to a certain point, some projects stop becoming viable. I think there's a direct conversation we can have here about, is the intent of your policy, or is a likely outcome a reduction of investment in gas in Australia?
It's certainly not the intent. We believe that gas is going to play a very important role for a long period of time. We recognise the risks. I know one of the stakeholders that we meet with is the Australian Energy Market Operator. I know they've been calling risks around sort of gas shortfalls, need for sort of infrastructure. I think they've recently reduced the level of concern around that given the current conditions. So in that sector in particular, we are happy to continue to support it, but one of the translations that we have to be able to make between where we say we make a commitment to Net Zero Banking Alliance, part of that, and we published this in 2021, which was by 2025, which obviously we are nearing, for any of our customers that derive, I think it's 15% of their revenue or more from oil, gas or met coal. We need for them to be able to publish a transition plan. Now, many of these companies are listed companies. They already have transition plans that cover scope 1, 2 and 3. And so in essence, it's subject to them having a transition plan that's broadly consistent with net zero with Paris over that period of time. We published that, as I said, with giving sort of 4 years notice. And we're doing that simply because we can't hold the commitments that we've already made alongside that without that sort of evidence. It just simply wouldn't be possible. So we've, as I said, published our policy, our intent, our plans. We have lots of engagements with customers. Clearly, for some of customers in the fossil fuel industry, that is a difficult ask, given where technology is currently at. We're sort of absolutely alert to that issue, and we'll do the best to resolve those simultaneous commitments as effectively as we can be.
I appreciate the delicate situation of it and trying to balance those, and I think this is the real point here around priorities. But I want to just touch on something, because it wasn't that long ago that Glencore's Great Artesian Basin carbon capture scheme had a lot of external consultants saying this was a legitimate scheme, until public pressure turned that on its head. And so I guess you can see my concern here. How do we know when you're making these, you're getting external consultants to tell you that this is a legitimate pathway? We've just seen one of the biggest carbon emissions projects, or emissions reductions projects, spectacularly fail in Australia, despite multitude of support saying it was a great thing. How do we know? How do you know? Because you've got a balance to make, but how could you possibly, in that case, if you'd been exposed on that project, it's very legitimate that everything you said would have held. Mm-hmm. You would have had no troubles supporting that project. It was actually public pressure that turned that around.
I mean, the short answer is it's incredibly difficult. And we're in the position that we're in as a financial institution, is we have to deal with all stakeholders. Often nobody is entirely happy with us. I mean, in the case of Glencore, I've looked at their transition plan, but perhaps that was 18 months ago or so. I think they had a valid transition plan across scope 1, 2 and 3. Now, expectations change. There are varying views about the need for sort of expansionary gas, whether that gas should be directed domestically, whether it should be directed internationally. There's a number of policy commitments within that. We recognise that it's at times shifting sands around stakeholder expectations. I think from our perspective, the best that we can do is try to navigate through that, to publish and be very clear around both our policy settings, our progress against that policy, where we're ahead of progress in other sectoral pathways which don't draw as much attention as some of the fossil fuel where we're behind. We haven't published a glide path in agriculture. We're working very closely with a number of our agricultural customers. We're trying to help them with some technology that hopefully will help, manage and measure their emissions profile. I was in Townsville last week. A number of our agricultural clients there are interested in, carbon sequestration via various soil projects. We think the development of carbon markets in a certified and credible way is extremely important. It is a very difficult issue.
And I think the point is, I have no difficulty watching you answer the questions Dr. Molino raised earlier around the fundamentals of banking. This is what you're across. Are banks even in any way placed to engage in public policy and take positions on this? With it? Everything you've just spoken about, your full answer there showed the compromised position of decision making that banks are in. Wouldn't it just be better to get out of politics and do banking?
Well, I can assure you, we certainly do not seek to enter politics. Unfortunately, in this area...
Well, I've got to say, though, you kind of have, and forgive me for picking at an old scab, but you rather did on The Voice a little bit. That was an entry into politics. On this issue...
We'd say that as a policy
I know you're
issue,
following
I don't want to
a broader...
get bogged down in that. Yep.
Yeah, I think it's relevant to the comment you've just made. You don't want to do it, you have.
Well,
you're doing it again
policy
on this
intersects
issue.
with our business. We feel like in this particular area, we need to have a position. I mean, are we going, in terms of commitments. Well, we're a major financial institution. We have, we operate in many markets. I think it's very difficult to not have, in fact, I don't know of any stakeholders or frankly even governments that aren't committed to net zero by 2050.
Oh, absolutely. No, the question is more, and on the Glencore issue is a great example. You've made commitments that you do not have the capacity to know that you will meet, because that's everything that they showed lined up. They had a perfect strategy, a perfect transition plan, and then it falls apart. And how on earth are you positioned to understand that? You've had to make the commitment that you'd take that into account, but you're not set up to do this, and it's for no negative statement at all. It's not the work of a bank to be doing that.
Well, it is a very challenging area, but I was using Glencore more as an example, and I certainly don't want to go into any more detail than I already have as a company that had published, a transition plan. Certainly there'll be companies that we will rely upon. There is expertise inside the bank. I certainly do not consider myself an expert in a number of these areas, but I mean, to give you an example, the chair, Paul O'Malley, and I would meet with the CEO, sometimes the chairs of a number of different energy companies. We'll meet with the energy market operator. I mean, as much as I would like it for something perhaps that banks weren't having to be involved in, the reality is we have to make those judgments. And so we'll certainly try to do that with whatever capability we have. And it's also an area where we've needed to, and we have made significant investments to bring a lot of capability into the organisation. But I mean, simply put, it's a very challenging issue. We have a much greater direct exposure to, and we publish that in the climate report. So I mean, to give you an idea, we would have less than $3 billion of total committed exposure to fossil fuel extraction, which would be approximately 0.2%. We published in our climate report $16.5 billion of home loans in areas that have got direct exposure. We'd have another $30 billion of home lending exposures as well. So, I mean, there are both moral, strategic, economic reasons to try to balance all of these factors as best we can. Will we do it perfectly? I'm sure we won't. But what we can do is publish clearly what our intentions are, to report against those, to open ourselves to scrutiny and challenge, and to try to continue to make the best decisions that we can.
If it were the case, and I appreciate it's not the intention, but I think it's a reasonably acceptable situation to suggest that the policies that you have in place put extra costs onto gas projects. They have to have a transition plan attached to it, which has a cost to it. And this could have a downward impact. It's reasonable to see that would have a downward impact on the amount of projects available, and thus the amount of gas sources that we are opening up. If that were the case, have you guys considered what an impact would be on gas prices? Like how many projects do you think slip from being profitable to not? I mean, just talking about, you've sort of talked about your responsibility, moral being one of them, economic, working for all of Australia, and they're all absolutely right. You can demonstrate that across a number of things. But on this issue, if your policies are reducing the number of gas sources that Australia can open up, have you guys modelled the impact that will have on gas prices? You reduce the supply, demand stays the same, you will drive price up. Have you modelled that?
We have a part of our economics team specifically looks at some of these areas. I mean, obviously the spot price for gas is set on a global market. There's no question that some of the costs would have increased associated with these projects. I'd have to take it on notice. But, I mean, it is, and it's often described, and I sort of want to avoid the hyperbole, but it probably is the most challenging and complex problem that we have to solve collectively, globally, over the next 2.5 decades. And we can't see a better way or an alternative way than the approach that we're taking. And I recognise that is not easy for our customers, for individual industries. We're relying on significant improvements in technology. But I mean, you either believe in decarbonisation as a matter of science and the importance of it, which we do, and broadly I think almost everyone does, then it becomes much more about what are the right sort of short-term decisions and choices. And I accept that reasonable minds can differ. There is a broad range of different perspectives. Some of them can be, in my view, equally valid. We have to try to intersect and find the appropriate point.
And I acknowledge the complexity, and I think that's what deserves the further scrutiny to make sure that we're making appropriate decisions. I guess the last sort of part on this, Chair, you talked about the balance and that you have to achieve between growing an economy and meeting these commitments. And in your opening comments, you talked about cost of living. You've acknowledged in other answers that right now this is the number one issue. Every household that I door knock, I'm sure my colleagues will be the same. This is the thing that everyone's talking about. Do you think this policy now that is making it more difficult for resources, so coal, gas, to get finance, to seek investment in Australia, is it right for now? Is it in touch with Australia now? Because we've seen gas prices increase 33% in 2 years. We're seeing people make very difficult decisions, as you've described previously to previous questions. Have you got that priority right now, or should the priority now be more towards reducing the cost of gas in a household? Should the priority be more towards further investment in gas, as is requested by AEMO's 2024 statement, Labor government? The only people who are pushing the other way would be the Greens Party at the moment. And I don't think you intentionally want to be aligned with that policy position. But that's where it would stand at the moment if that was your priority.
Well, respectfully, I think it's a long bow to draw between our policy and impact on global supply and demand of gas and pricing.
We could talk about Australian supply and demand.
But look, what I do agree with, but it can't be that these principles are sort of mutually exclusive. I mean, I think what we are worried about, and I'm sure the government is as well, is that Australia has a secure energy platform. We have the lowest cost power possible, and alongside that, we decarbonise and meet our net zero commitments. And unfortunately, not all of those are entirely in tandem at all points in time. They're not all perfectly reconcilable. Do we think it's the most appropriate policy? We do. I mean, we published it last year. We have not made any changes. It is a topic of ongoing debate and discussion. I mean, we would talk about our commitments here at every board meeting, more just to give you a sense of, I mean, the amount of weight, notwithstanding the very, very modest commercial value that's at stake. We're acutely conscious of it because of the broader and challenging landscape that we have to be able to navigate.
I appreciate that. I guess when households are seeing their bills come in and they are increasing and they have kept increasing, and they see commentary that it's going to be harder for gas companies to seek investment in Australia and to get that support that they have been previously, and that lines where you're walking away from them, I think it has an impact on people's, the way people, their confidence, what they see in the future, and that has an impact on our economy. I think it's something that we should be prioritising, is addressing cost of living and more gas sources. I can't see an argument at the moment that the Australian people want or to see a priority placed on less gas.
And I certainly agree with that in the context of for domestic supply, that perhaps would be less support for international. But I also believe in Australia, whether it's the right policy or not, we also have to honour the commitments that we've made internationally in terms of the export of gas. I can assure you we are not anti-gas. We are very constructive. We have financing to that industry. We would be prepared to continue to finance that industry. But it has to be consistent with, we can't simply waive other commitments that we've made. That I think would also erode trust.
Thank you very much for your time.
Pleasure.
Thanks, Chair.
Thanks. Mr Luxale.
Thanks, Chair. Thanks, Mr Common and Ms McLeod for being here today. I've got a little example here. So if I buy a cup of coffee in cash, it costs me $5. If I buy a cup of coffee with card, it costs me up to $5.08. Why?
Well, it would also depend on the cost of the cash. Let's just assume a business that was only accepting cash. You'd probably be paying $5.20 for the coffee. You'd just be handing over the cash and the coins, because the 4% of the cost of the coffee is embedded into the higher prices. It
doesn't cost me $5.20, it costs me $5.
It's a difficult comparison to make, Mr Laxale, because you have to understand that with cash, I think there was some research that was published in the last couple of days, which shows that, and I've seen surveys that are substantially higher than this, but it equates the cost of cash acceptance at about 4%. I think it puts buy now, pay later at 8%. The cost of electronic payments is less than half of that. I'm happy to talk about the electronic payments market in as much detail. Typically, if a business, yes, customers have never paid a surcharge for cash, but the cost of carrying that cash at a business level, just like any other input cost, the cost of the coffee beans, the milk, is embedded into the price of the cost. So it's not a like for like comparison.
It's still $5 out of my bank account compared to $5.08 out of my bank account. They're both money. I think in 2024 it is like for like.
If the cost of the good is higher than the surcharge,
why
then
are
it's
costs embedded for cash but not embedded for digital?
because the entire mechanism of electronic payments domestically and globally, and I'm happy to talk about it in as much detail as you'd like, historically is the way that it's charged. And Australia, unlike Europe, allows merchant surcharging or business surcharging. They are able to surcharge the cost of the acceptance. I think there's a reasonable hypothesis that at least some businesses are surcharging more than the cost of acceptance, but there is no data on that. That is one of the things that the RBA is analysing. The cost of acceptance of electronic payments has fallen by more than 30%. We are one of the lowest, if not the lowest, cost of acceptance markets in the world. We're a fraction, as an example, of the US or Canada. The domestic payment system is extremely efficient. The Reserve Bank, as I know Governor Bullock spoke about recently, has announced a review. I have no doubt, as there has been over the last 2 decades, there will be ongoing pressure to reduce interchange. There's a number of different elements about what shows up as $5.08. There's different parts that contribute to that. I've no doubt that that will continue as marginal costs in businesses continue to reduce. But I mean, fundamentally, the electronic payments infrastructure and I think the service and the commercial outcomes for the economy and the industry as a whole are extremely efficient and competitive. And if I may, I don't think it's appropriate when others, describe that in terms such as a rort. I don't think that's factually correct.
So you mentioned some of the costs involved in your business dealing with cash. You've come out publicly and said that costs $350 million. You've mentioned you're just giving a lifeline to Armaguard and you're contributing. You embed that in your cost of business to a small business. But you treat digital differently. And I guess that's what I'm trying to understand. Why do you treat digital differently to what you do for cash?
Well, I mean, we don't, but let me try to go back.
You do, these are two different figures, right? Like you said that this was $5.20. That's not $5.
They're very
that's
different.
$5.
But they're very different. There's different mechanisms. I'm happy to talk about cash, the different costs of
well, not
cash.
to a wage earner, it's not.
But I mean, generally, there is nothing ever that is free. As you know, as the technology industry has indicated, if you're not paying for a product or service, you are the product. Now, that doesn't mean that there's always a charge to a consumer. Sometimes that's cross-subsidised. I mean, I know you're familiar with the NPP. That's been funded by the banks. I think we've invested more than $250 million. It's got to be more than $1 billion. That's a piece of infrastructure, which at the moment, yes, that is free from a consumer perspective. But in effect, that is cross-subsidised somewhere else.
Sure.
It is somewhat analogous to if the government spent $50 billion on NBN, you wouldn't reasonably expect to provide that for free. It's just the costs of where these services actually are charged and where is the most appropriate. So businesses are paying less using electronic payments than cash. I don't think those facts are in dispute. In this case, it really comes down to whether the lower costs of those inputs are being passed on to consumers, whether the cost of acceptance is as low and as efficient as it could be, whether the surcharging, which is supposed to be the reasonable cost of acceptance, is the right amount. And these are all issues that the Reserve Bank is looking at. I mean, we have, approximately the cost of acceptance on debit interchange is 6 cents. I think that's the lowest anywhere in the world. It's a weighted average of about 50 basis points on credit cards. The cost of acceptance would be, across both of those, probably about half of 1%. And so it's very difficult to make comparisons where it's just not like for like. I can assure you there's been a lot of downward pressure on lowering the cost of payments. There's been a lot of investment in making the payments infrastructure much faster, cheaper in this case for consumers. There are also risks associated with that. I mean, if there's one thing that the NPP has certainly accelerated, is that with real-time irrevocable payments, there is no chargeback, dispute mechanism or recovery. And I mean, just to make that real, so we send about 20 million payments every day. We would, over the course of a year at the moment, be processing about 5 million disputed payments over per annum. So, and the largest contributor of that, ironically, would be Apple. So you can imagine everyone who's paid something electronically where there's I can't remember what that is, or I didn't get the goods or services. There's a whole process around that. The dispute process alone would cost $100 million. So there's definitely benefits associated with electronic payments. I think it should be tested, and I know the RBA are going to test whether the current levels of interchange are set at the right level, notwithstanding they are very low by global standards, whether surcharging is appropriate, whether that, and what that sort of impact would be, because effectively we don't receive any money from surcharging. The surcharging goes to the small businesses. Now, I think all of those factors need to be weighed up. There's been substantial investments in the payment infrastructure. I don't say that begrudgingly.
The surcharging goes to small businesses to pay your merchant fees.
To offset the costs that they no longer pay in the context of cash. And I understand. Yeah. I mean, I deal with businesses every day. I know how challenging the current economic climate is, and inflation, and particularly for smaller businesses. So I certainly, I have a lot of empathy and understanding of that. But I think some of the facts that are often furnished are, either grossly exaggerated or inaccurate, including the cost, which has been sort of reported at $4 billion. That number is just simply wrong. And we're happy to show you the workings and the calculation of why we believe that's at least overstated by 3 times. It is a complex area between interchange, issuing as a card provider, merchants, which is merchant acquiring, where effectively you tap, LCR, NPP, all of the alternative payment mechanisms, the chargeback liability regime, how disputes work. It is probably one of the more complex areas of banking. I'm happy to provide as much information as you would like. We will work closely with the RBA, and ultimately, they will govern it. And it's not lost on me that one of the things that we mentioned in the opening is the PSRA, or the Payment System Regulation Act. Those amendments. I mean, that act hasn't been amended since 1988. And we're very happy to contribute to an ongoing review But I think it's critically important that some of these payment providers, which are imposing a more significant impact on the payments industry, are urgently reviewed, and the RBA is given the powers that they've been seeking for some time.
So I'll just go to some questions on your relationship with card providers. Having a browse on your website for personal accounts, it seems that you have an exclusive relationship with MasterCard. Is that right? So when you go, there's like 6 personal accounts and they all come with a debit MasterCard.
They would be our primary issuer in our Australian business. Visa would be our primary issuer, but we also do
MasterCard or Visa? MasterCard, yep.
Visa would be the primary issuer in our New Zealand business. Visa do a number, though, of issuers as well. So they don't have the same volume as MasterCard. Obviously, then it's co-branded with EFTPOS. So, I mean, we have a relationship, as you would expect, with every card issuer. But yes, there are currently more cards on issue from a debit and credit perspective that as the underlying issuer, MasterCard.
Okay, so describe your commercial relationship with them.
In what terms?
Oh, so do you get paid for this arrangement? Do you get paid per card issued?
No, you don't get paid per card issue. And look, if you ever want to while away some hours looking at the way the international card schemes, I wouldn't say it's not a simple thing to summarise, but
nothing's simple, Mr.
No.
Cash isn't simple. Card's not simple.
Cash is a lot simpler.
We
Cash
agree
is a
on
lot
that, right?
simpler, I can assure you.
Yes and no.
But broadly, there are fees. Well, maybe it's almost easier to. Customer pays, let's say I'm tapping. The terminal that I'm tapping, depending on what the product is, I may get the terminal for free. There may be a rental on that fee. There'll be so someone, you will pay, this is effectively your 8 cents. Then some of that is provided or given back to the issuer in that context. Some proportion of that would go to the acquirer or the provider of the.
I'm aware of the nuances there. I just kind of want to understand your relationship with MasterCard. It seems to be that there's some sort of exclusivity or do you get paid for that exclusivity? Like, do you benefit from?
We have a commercial relationship with them. We have a commercial relationship with Visa. Yes, we are paid. I couldn't give you the. Sorry?
How are you paid? Like in
a
what way?
variety of different ways, but effectively a proportion of the interchange that is charged, which clearly has come down significantly over time. I mean, that's the simplest way to describe it. There's more complex elements to it as well. It depends on what the card mix is. There's a whole range of different factors that drive because obviously the total interchange, you get a proportion of that.
Okay, so what revenue do you make off that relationship with MasterCard?
I'd have to come back to you precisely.
Okay.
I'd say 2 things. One, in our merchant acquiring business, which is where you see the merchant effectively tapping it, loses money. Lost money last year, lost money the year before. If you're interested, happy to go through the economics of that separately. On the issuing side, it's both then you have to think about it in terms of what the gross money that we may receive from the issuer, in this case at MasterCard, but it could easily be Visa. Secondly, what are then the costs? So just like in many other markets, some proportion, it's more than 90% of the economics that we're receiving on the interchange side, we basically give back to the customer in the context of points, often through the purchase of frequent flyer points. Qantas, could be others. So depends again, gross, net. The margins, I suspect, aren't as large as you might anticipate. I wouldn't like to hazard a guess.
Okay. Would you be able to provide that information?
I'm sure we would.
Yep. So you don't get any scheme rebates or anything like that?
There's an element around scheme rebates, yes. Some of that would also go into, typically, they will make a contribution that could be used for investments. It might be investment. We might use those dollars to invest in fraud, in technology, those sorts of investments. I'd have to look. It's been some time since I've looked at the structure of the contract, but there would be multiple elements.
Do you report any of these incentives or rebates or
everything
income?
is in our financial statements.
Okay, all right. Now just talking about EFTPOS debit in particular. So as far as I'm aware, all four big banks, but for your purposes, the CBA co-owns Australian Payments Plus, which is FPOS, NPP, BPay, all that stuff. And you've got a board member on APP. Is that correct?
That's right.
So how does this co-ownership work for you? Like, I understand they charge a surcharge, which you then pay APP. Like, do you get the same type of commercial arrangements from them for issuing cards, or?
Yeah, I mean, they wouldn't be identical, but I mean, substantially, there'd be a commercial relationship as you would expect in place. Yes, there's industry ownership. I can't recall what our precise share of ownership would be. There was obviously then a number of mergers across the entities that you referenced. What was that, a couple of years ago? And so I guess as the administrators of that scheme, and we, along with others, think it's very important to have a successful and competitive domestic scheme. We don't want to be entirely reliant on the international schemes.
So would you say your costs, the bank's costs in dealing with an FPOS transaction, are less than the bank costs in dealing with a Visa, MasterCard debit transaction?
I don't know that I'd make that conclusion. The mix is very different as well. So, I mean, the domestic or the FPOS is not sort of at parity on e-com, so there'd be a much greater proportion of e-commerce transactions would go through one of the international schemes. I mean, I'm not sure which part of the costs. I mean, I think the sort of directionally it'd be substantially similar. I mean, FPOS has reduced fees, which has also, over time, over the last several years, which has seen the international schemes also reduce their fees, which is...
The RBA says that, yeah, FPOS is lower than Visa and MasterCard debit. So does that reflect itself in your costs for...
They may be referring to that in the context of the interchange, which depends again on the transaction mix. I can't remember the specifics, but there would be, I think for the smallest transaction types, they may be. Then there's a crossover point where they aren't. And it's obviously, it's a matter for the schemes to try to determine where they want to position the pricing, because, you know, in effect, they'll be more or less competitive at various points. And, you know, as is the case in any market, that's something that needs to be determined over time.
But in terms of your revenue or profits off interchange, like the little bit that you take, and you said that margins are low, and I understand that, do you make more off FPOS or do you make more off Visa
in
and
absolute
MasterCard?
terms, because the transaction mix would be larger through MasterCard
Right,
and
per
Visa.
transaction,
I mean, I'd
yeah.
have to look.
Right. You don't know that?
I don't know off the top of my head.
No.
I'm sorry.
So I'm just worried that, according to the RBA, the cheapest scheme for Australians to use is debit through FPOS. They consistently have the lower rates.
Well, again, it's been some time since I looked specifically at that, but certainly the last time I looked, they were...
So they're as low as 0.2% for FPOS, as low as 0.4 or 0.5% for Visa and MasterCard. This is for turnover of over $1 billion is what I'm talking about here. So, like, I'm happy to show you the graph, but...
Sure.
But
happy to look at it.
Yeah,
It
so
may
they're lower
depend
for
on what the
FPOS.
arrangement is. There's a difference between... you know, the largest turnover companies, think the supermarkets versus smaller business. The cents versus basis points makes a difference as well in terms of where the different transaction sizes are. I mean, I think FPOS have been very competitive. We think that that's good.
They're
It's led to reductions in prices from the international schemes.
But they're the cheapest, and you don't have LCR switched, low-cost routing switched on for all your merchants.
but
Like,
we-
why are you pushing people onto a more expensive scheme by default?
We do have least cost routing enabled.
Enabled, sorry.
But we do.
48%.
Well,
of your
that's
customers.
48. I think it's 97%. It's available.
Available,
It's 48% in use. But see, this is again, and even I think one of the, to recall, it was a speech about 6 or 8 weeks ago, and in two of the tables in that speech where it references the proportion of transactions that are available through least cost routing, there's a little figure at the bottom or a footnote that says this doesn't actually indicate lower cost. So, like, to give you an example, all of the customers we believe reasonably that are benefiting from least cost routing have been moved on to, in most instances, a simple merchant plan. So that's it. Our pricing at the moment is 1.1%. We cut that maybe 3 years ago, it's one of the lowest in market. One of the companies that's referenced as 100% LCR is 1.8%. So, I mean, I could simply offer that simple pricing plan. A lot of our customers would be worse off, and I would be at the top of that box saying 100%. The RBA understands that. So it's sort of, you know, one measure. It's certainly not the important one. Then from within that, there is some aspect, though, with depending on what the merchant is, they do have preferences in terms of which scheme that they use. I can assure you, we've had ongoing dialogue with the RBA for many years, trying to make sure that least cost routing is available. There is not inertia being shown by customers. We're not relying on that inertia. We're trying to make it available to the customers where it makes sense. As I said, we've substantially cut our fees, but it also, as a matter of fact, if we just increased pricing and pushed everyone onto a plan, even though a great number of them would be worse off, we'd also be sort of at the top of that table saying 100% LCR enabled.
Does MasterCard provide you or your staff with any corporate benefits or corporate hospitality?
I'm sure they do.
Okay.
I have not availed myself of any of that corporate hospitality recently.
Dinners, sporting events, bottles of
I
Grange?
mean, any sporting events, I probably have at some point in the past, but not for several years. Dinners? No. I mean, MasterCard as an example, I would see the CEO of MasterCard either in Australia or in New York. Don't recall that being ever over dinner, mostly in their offices or mine. That is not a significant component of certainly my
Are your
interaction.
commercial arrangements with MasterCard inhibiting lower costs at the checkout for consumers?
I don't know how you would draw that conclusion.
Well,
Are you
the fact
asking me or are you telling me?
No, I'm asking you. I'm asking you. Like
No.
you don't think they are?
No.
No.
Absolutely not.
Even though MasterCard debit costs consumers more than EFTPOS debit?
Well, depending on the transaction, I don't think that's true of all transactions. I'm very happy to provide that. And I'm certainly not a lick spittle for MasterCard. I'm sure they're capable of representing themselves
I only
as
choose
well.
MasterCard because that seems to be your preferred provider, that's all. So,
Well, we have a larger relationship with them, but no, I think I'm sure they would speak openly that their pricing and margins have reduced substantially in Australia. It would be, as I said, one of the lowest cost acceptance markets in the world.
is it cheaper for Commonwealth?
If something is free, something can always be cheaper until you go negative, but that doesn't mean it's not fairly and appropriately priced.
Is it cheaper for Commonwealth per dollar to trade in cash or digital payments?
Sorry, say that again. Is it cheaper?
Is it cheaper for you per dollar to trade in cash or digital payments?
Oh, it should be cheaper in digital. But it's a scale economy effect, Mr. Laxale.
That's what I said, per dollar or per...
I mean,
per
as I said, I mean, the cash in circulation, I still find this somewhat remarkable, is almost at the highest level peaks, even though the level of payments for cash has gone to, I think, 13%. We distribute about $4 billion out through our ATM and our branch network. We process approximately 20 million payments per day. So as you would imagine in any sort of fixed and marginal cost business, the marginal cost on an electronic and digital payment has come down substantially, and those cost savings have been substantially passed on to consumers.
Digital cost savings have been passed on to consumers?
Absolutely. I mean, all of the evidence will show. But again,
that's not a saving.
But no, again, that is a...
That's not a saving, well, that's more.
It's a false comparison. And look, I'm certainly not directing this at you. Well, not... You know, I find it somewhat alarming in the context of this is not about the Commonwealth Bank, but, you know, I see this now again and again. Over and over, businesses in Australia are being, you know, represented in this false dichotomy that for a company to earn any sort of income or profit, it is therefore inferred often or directly related, and not necessarily by you, Mr. Laxale, but on a daily basis, as somehow being unjustly extracted from consumers. And I think this sort of, you know, continuing, often sort of fact-free rhetoric that's being you know, published more broadly is very damaging. And I say that damaging insofar as I think it is, you know, it is really eroding cost trust in institutions, in all of our institutions, and I think it's a real cause for concern. I mean, I've appeared. I think this is my 15th time in Parliament. Mostly in the House, many in Senate estimates. I have no issue. I'll appear as often as anyone would like, answer whatever questions that we can. And particularly in 2018, it's not about transparency. It's not about accountability. There were issues that we should have been heavily criticised for, and we were. But I just see too often now, there is, particularly in the external environment, sort of claims that are made that are just not demonstrably true. And I think that's weakening and driving sort of a fundamental distrust of across citizens. You must be seeing it. We are seeing it, and I think it's a real cause for concern. And I don't think the right thing is to sort of position things when they're sort of factually incorrect. As I believe that you are, but as I said, this is a much broader sort of comment. I think the policy that was announced yesterday is just insidious popularity, and I think it's a real concern. I think it's going to drive a fundamental distrust over the next decade, which should be a real cause for concern. I think Australia is a very special place, which we have inherited from others, and it relies on a rule of law and that law being upheld, and it relies on a sense of trust and civility and community sentiment. That's why Australia responds to lockdowns, responds to vaccinations. It's very unlike many other countries and economies. And I think the internet has obviously accelerated misinformation, but I just see too often there's just not enough onus being put on people that are furnishing facts where it is what they describe as facts, where they're just demonstrably false. These claims of gouging and leading to CPI that's just not right.
Thanks for that commentary, Matt. I am presenting facts here, right, to a consumer.
It's not a like-for-like comparison.
It's money that people earn,
those.
Right, and they buy the same thing, and it costs them different, and that's what I'm trying to get to the bottom of.
Well,
and
hopefully, over the last 20 minutes, I've tried to at least illustrate that the price of the coffee is different.
Thanks for your evidence. Thanks for your evidence.
You're welcome.
Ms. Spindler.
Thank you. I'd like to change tack and talk a little bit about lending to businesses. I've noticed that over the sort of, I think, the last sort of 30 years, the amount of money that is amount of sort of lending to businesses by the major banks has gone from, I think, about 55% of your book to about 30% of, not your specific book, but about 30% of loans from major banks. And at the same time, I think we've got. And when you're looking sort of in more detail at what sort of lending goes to sort of emerging businesses in particular, what you see is that there's very little unsecured lending by banks now. Certainly coming out of the RBA figures, it's almost vanishingly small amount of unsecured lending by banks. And so I'm concerned. I guess the reason why I'm raising this is because we're seeing entrepreneurs getting older. We're seeing productivity not going where it needs to. We know that young, dynamic firms are the ones that drive productivity, drive wealth creation. And my concern is that the banking sector is not in place or is not playing a significant enough role in trying to actually finance and grow these businesses. So I guess the question is, how can banks get involved in actually helping more businesses grow, particularly those who don't have a mortgage, who don't have a house, basically, to back their business?
Well, thank you. I mean, there's a lot in that question.
I know, it's a lot in that question.
Look, at a high level, what I'd say is, and certainly in our business bank for at least the last 4 years, we've been growing at more than 10%. I'm happy to sort of step you through all of that. We've tried to grow our business bank strategically. We believe it's really important to be able to extend capital to productive areas of the economy. Home buying, home lending is an important part of our business mix, but there's certainly, in the country's interests, a better use of capital to deploy for productive capacity. We support a lot of businesses. That growth has been very diversified. We provided a lot of support during COVID. We underwrote about 50% of the SME loan guarantee products to all of our smaller business customers. I mean, I wouldn't say that we are great at startup because, I mean, for a financial institution, there's at some point equity.
I agree.
And where debt looks like equity, that's not necessarily in our risk appetite. It depends. We certainly have supported and have lent to a number of different businesses. It may be easier to work through specifically, any of the individual sectors of concern. I think we are very focused on continuing to grow on a diversified basis. Obviously, housing affordability in terms of the supply of housing would be, at the absolute top of our overall priorities. We've touched on decarbonisation, housing affordability, obviously inequality more broadly. But maybe it's helpful to go into some of the more specific examples.
Look, I guess the question I have on that is I see where you're saying you've grown it, and I think I guess my question is, do you think there's enough access to capital for the sort of productive firms for us to actually drive the sort of productivity, and which I know you've spoken about in a number of occasions?
I do, but that certainly doesn't mean that statement is without challenge. I think what we have tried to do, and there's actually a number of things that we're improving this year because of the information that we understand of our customers. We're actually making it a lot easier, particularly in small business over the course of this year, to take out unsecured or facilities. I think up to $500,000. We can do that from application to in your bank account in about 12 minutes. So, I mean, continuing to roll that out, of course, responsibly, is an important priority for us. I mean, look, to give you an example, one of the pressures that are facing small businesses at the moment, or businesses generally, is the ATO, quite reasonably in my view, is recalling some of the outstanding tax debt, which was often used as working capital. There's about $50 billion of that outstanding. Probably about $10 billion of that, by and large, might be to Commonwealth Bank customers. We've changed our policies so that we can support customers with the ATO debt. I can't remember what the cap on that might be. Maybe it's $500,000. Because if you have to repay the ATO, you have to do that at 11.34% interest rate over a 2-year amortising loan, which is quite challenging. So and I think it's in our customers' interests. We probably have some of the capabilities to be able to manage that debt. So to try and just give you examples, we obviously have to be very cognizant of the decisions that we're making, because if we put either our customers or ourselves in a position where too many of those loans are not being repaid, that would be problematic. But fundamentally, at the heart of our business model is having a risk appetite that supports businesses, and there's nothing that gives us more satisfaction than lending to a small business that then grows into a large and successful business.
And I guess institutionally, not just your bank, but also in the sector, is there anything from an institutional, from APRA or other piece, which would actually encourage greater lending into the business sector? In appropriate lending, risk-managed lending?
No, look, I think my personal perspective on the role of the regulator and the potential regulator is I think they've made very good decisions on the policy perspective, and I think they're in the right long-term interests of the country and financial stability. Lending criteria has been tightened over time. I mean, that's one of the reasons why Australian banks are in a pretty strong position as it relates to commercial property. Commercial property has probably been a significant contributor to something like 90% of bank failures over the last 100 years. We are always looking at some of those settings. I think those settings are broadly within our control. I mean, specifically, sort of housing supply and development in particular, whether we might be prepared to, and it certainly will be accompanied with risks, expand our appetite. We're working with different capital players in terms of people who are prepared to either lend alongside us. We're obviously working with the relevant government entities to be able to, the HAF to try and support more, affordable and social housing. It has to be a collective and shared effort across governments and multiple parts of the industry, we're just not on a good trajectory on the supply of housing. I think this is a really significant issue. So that's probably one area. But look, we go through our risk settings, very regularly and trying to strike the right balance.
Okay. On a different note, a number of people sort of remark about CBA's investment in technology over a period of time and how that has helped to sort of drive, I think, your market dominance and, your performance over particularly the last decade. And there's a big question, sort of data basically, is power in sort of this kind of world. And, the big question about things like positive reporting and open banking and whether, the sort of accumulation of data is actually is whether we're actually getting the benefits from a competition point of view of, sharing data. Obviously, open banking's not really working particularly in terms of, uptake, but we don't have things like positive reporting in this country so that people can, come in and offer different options to customers based on, better understanding of risk. So I wanted to ask about, how does CBA think about that sort of data sharing and whether that could drive more competition?
Look, we have, obviously made significant investments to make the consumer data right and open banking come to market. As you mentioned, look, the uptake has not been particularly high. It hasn't been in any other markets either, to the best of my knowledge. I don't think that's entirely surprising either, given the very genuine concern that many people should and do have about sharing data with third parties and where that data might be used. Clearly, security and privacy data is a very significant issue for us and for other companies. I think, look, there is comprehensive credit reporting in terms of consumer, so through to unsecured and secured. Look, I think that's certainly been helpful to obviously understand the customer's broader financial position. I do think things like digital identity are actually very important. I think we may have to go down the path, because we can't think of a better way in something like insurance, to have a better understanding of current coverage levels and insurability, particularly in high physical or climate risk areas, is a significant issue as well, and will continue to grow over time. So look, I think our approach overall is, with the appropriate safeguards, sharing of data and information, it can be very effective. Clearly, we try to understand as much as we can about our customers, try to deliver them the best service experience and the most personalised and relevant. And we try to understand, the economy as best we can. And we share that data where appropriately.
Okay. And then lastly, just going to scams. Australia has loses more per capita on scams, than sort of comparative countries. I think the UK, we're losing about $100 a head, and figures I've got from the UK is about $34. The US, it's $45. So why are Australians losing more money in scams here than other countries?
Well, so in scams itself, particularly versus the UK, it's a little difficult to do the like for like. I can run you through what the numbers are. The way the UK scheme has been established is it only covers a proportion of the scams. It excludes some of the scams that are prevented. So the like for comparison for Australia is much higher than it would otherwise be reported. I think what we can see though, and agree, and it was published in some of the most recent reporting, is, as I mentioned, our losses to customers in the last 12 months or in our financial year were down just over 50%. And of course, a dollar being lost to a scammer is a dollar too much. Then, if we look across the industry, I think it was down 13%. The UK is only down 5%. I think, notwithstanding, I mentioned in my opening, we're spending $800 million in cyber scams, fraud, financial crime. We will invest more than $130 million in scams alone. It is extremely important that the other sectors, there's more than 70% of scams originate either on social media or a tech platform or a telco, are brought into, and we are able to work constructively and rapidly. We simply won't be able to reduce it. And this is the evidence that's come out of the UK. Even the UK finance in their most recent report, have said they think it's inequitable and it's not effective. And it's often reported in Australia that I'm not suggesting you're saying this, Ms. Allegra, that the scams policy that's in place in the UK has been really successful. It has not. Scams have not reduced. The company that introduced that, whilst I'm sure that was a noble cause, has been adverse selected. I think it's been a disaster for them and for their owners. And and as part of, I think, hopefully, one of the more important things in the opening is we're making as much progress as we can. The commitment is shared across all of the institutions. This is a regular topic of conversation at the ABA. We cannot do it alone. Yep. We need the regulations and legislation and the code to come into effect. We know that that will come with greater liability. We think that that's appropriate. It's the most effective way to make Australia a less desirable nation for scammers.
Yeah, I take the point that it's not the banks alone. I absolutely take the point that this is there are different sectors and they all play their part. I guess the question is, and I think it's great to see, Westpac and CBA introduce, pay sort of recognition and things like that. Some of that verification piece. My question, I guess, is whether the incentives are strong enough yet. We haven't got the new incentives in, but whether we've had strong enough incentives to date, but also whether we've got strong enough incentives even in the case if we bring everybody in, will they be strong enough for the banks to be investing at the level, frankly, that the community expects? Because the sort of technology you've got, my question is, why didn't we have that sort of, couple of years ago, given it's been identified as technology that frankly would have made a real difference?
Look, maybe in response to a couple of those points. Again, going back to, so we process about 20 million payments per day. And obviously part of our job is to act on the mandate that our customers give us, in this case to perform a payment. We would block or stop or interrupt about 20,000 payments per day. They can be fraud, they can be scams. When we get down into perhaps the small number that are still getting through, that's probably in the order of a couple of hundred a day. So that's a couple of hundred against 20 million. So now I'm down to 0.002%. It gives you a sense of the needle. It's just it just isn't possible for us to be able to predict with any degree of certainty which of the payment instructions of that 0.002% that we're currently letting through that might be a scammer. And obviously scammers and the technology that's that's continuing to evolve helps them to continue to try to make it harder for us to pick up and detect. This is an issue that will never go away. Do I think there's an incentive? I mean, to me, the incentive couldn't be stronger. And I think one of the reasons why we're advocating for industry codes, mandatory codes that will intersect, those codes will be administered presumably by the ACCC. If we're deficient in our program around the implementation of that, we'll be fined, and we should be fined. The intersect of those codes will also lead to, I think it should, a proportionate liability. So if we're found to have not done what we said we were going to do, if we're providing information into a intelligence loop, which we are, and the company didn't take down the ad or the bank didn't act, because once you are alerted to something, that's a very different set of obligations, then you'll be paying out greater levels of liability. I mean, our strongest point, I think, on behalf of the industry is it just, and I know you're not suggesting this, it just makes no sense. And we very much welcome the approach of the government to sheet home the liability to a sector that cannot possibly resolve it in isolation. And whatever urgency can be brought to implement the steps that that I've set out would be welcomed and very much appreciated.
Look, I guess I read an article today that certainly in terms of putting pressure on the government, I'm 100% there. But in terms of, I was reading an article today where I think it was the deputy chair of ASIC had been scammed, and I guess that's the question: if the deputy chair of ASIC's being scammed, how can we how can we actually protect our consumers against these sorts of pieces? Because there are a lot of clever people who are very financially illiterate who are being scammed, and I think this is really that's why I keep coming back to, are the incentives strong enough to deal with this? Because this is a huge issue for across the community. Oh,
well, I believe there are, but perhaps not go into the specifics of that example. But I certainly maybe an analogous one. If let's say a scammer sets up a fake shoe
Yeah,
company,
which is
and sort of seeks to emulate.
Yeah.
That is then published on social media, and it's left on social media for an extended period of time. Now, you can imagine the person who then goes and purchases the fake pair of shoes from the fake. That would be, in my view, unless there was any prior warnings, almost impossible for anyone to detect. Now, the importance of why that this is, because let's say that this particular person who's then been scammed reports that should go into the exchange that's been set up. That intelligence should be shared. There should be obligations on wherever that ad or that fake merchant is residing and being advertised to be taken down within a specific period of time. If it isn't, there's a penalty. Other financial institutions should also be on notice that if the payment instructions were going into a particular account, if an account or a merchant facility has been set up fraudulently, not to process transactions, it's the speed of which the information needs to be shared that will create the obligations that will help us to, if we can't eliminate, because I don't believe we'll ever be able to, even with the best of commitments and investment, but we should be able to minimise. And we've seen, I mean, even in our experience over the course of the last 12 months, and yes, I accept your point that would have been great if we'd done some of those things earlier, but I guess that's always true. We've been able to make a really significant, more than 50% dent, but we also should be alert to the sophistication on the other side of both cyber and scams and fraud is going to continue to increase. So, it just has to be an environment where companies across multiple sectors are working constructively and collectively. They're not seeing it as an opportunity to commercialise any of their products or services. There's just very clear obligations that are there to limit losses to Australian residents and citizens.
And if I could just add, Matt, the intelligence loop that you've mentioned and the way that can work, we do have some examples that are live. And in particular, as one of the first that signed up to the intelligence loop, we are passing information to others, and we've been able to see that take down. So I think back to Matt's point, we want to make sure that we can have everybody in the loop and have that moving as quickly as possible. If we can get some speed behind that, we know that we'll be able to make a real difference. And so, unfortunately, as Matt said, that very first instance may be very difficult to find because it does feel like a bit of a needle in a haystack. But the minute that's into sharing that information, we should then be able to address the onflow of that for others very, very quickly.
Okay. Look, I'd love to have the data points that you're saying in terms of comparisons, because the figures I've seen is to say that Australia loses more per capita than, in other countries. I want to understand the difference. Sure. My final question is just on tax. Matt, you've spoken up significantly about the need for sort of tax reform, notwithstanding your comments about what the discussion yesterday. But I wanted just to ask, really, in terms of why is this? Why do you see this as a priority for the country? This is my personal hobby horse. So
no, I understand. Look, I think it's an important area of policy. Yeah. It's generally, and I think wisely, an area that many people seek not to enter. I'm happy to recap my views. I'm not suggesting they are easy, I do not have a particular expertise in tax, but I've read a lot of the materials. We have a view. I think over time, tax reform is a critical element of that. I think the tax system at the moment is not as efficient, simple and as fair as it could be. I think we're over-reliant on income. I don't think we're taxing wealth as heavily as we could. I think it's part of a broader structural issue that needs to be addressed. I understand that the changes are always very unpopular. So I certainly, it's never a criticism about any government because I can only imagine how difficult it would be. But I do believe that in time, it's a critical structural reform that will be necessary to drive continued prosperity and productivity.
Okay. Thank you. Thank you. Thank you, Chair.
Thanks very much. So we'll now suspend proceedings for a short break, although you probably need it less than last time you were here with COVID. But nonetheless, I'm sure 15 minutes will be good for recharging the batteries. We'll resume at 11:25.
Thank you.
Proceedings. I'll now hand over to Ms. Lawrence. You're on mute at the minute, Ms. Lawrence, if you're trying to ask questions. I think you need to unmute yourself, Ms. Lawrence. She's saying, can they unmute me?
Can they unmute me? I don't think they can. Can you guys unmute Ms. Lawrence? No. Can someone go ask broadcasting, please?
Ms. Lawrence, I think if you're going to have to unmute. I'll give it one more sec. She's under time constraints, so I'll have to get her on now. Should I? Well, look, just while Ms. Lawrence is working out her IT, we might go to Ms. Payne, and then we can switch back to Ms. Lawrence in the middle, in that I think she is under some time constraints. So, Ms. Payne,
She's gone off. Maybe she's going to dial back.
sure.
Apologies.
No problem.
Okay.
Thank you very much. So I'll now hand over to Ms. Payne.
Thank you, Chair, and thank you very much for being here today. I wanted to ask about scams, and you've talked about that in your opening statement, and talked about the 4 things that you believe are important to addressing scams. Of course, the code of conduct, information sharing, obligations to act quickly, including to close accounts, and a shared liability scheme. I'm just interested, is Commonwealth Bank already implementing any of those, particularly the obligation to act quickly? How does your bank act quickly when scam activity is identified on your accounts?
I mean, look, we certainly are. And one aspect, the only other piece I would add in terms of the things that we think are important is a single front door for customers to go to when they're in an external dispute resolution scheme. I think it would be very difficult to go between multiple sectors if you're a customer. Look, we are certainly acting as fast as we can. And it's not to say perhaps there are, not that I'm specifically aware of, areas that we could be acting faster ourselves. Where we see real opportunity, though, as well, is for industry and across industry support, where, and I mentioned in my opening statement, we're providing information into an intelligence area which is then shared. This is effective in other domains, and so what we really want to be able to do is see, because there might be a scam that we're seeing that other banks aren't, and they'll move on to another financial institution. It might be a particular type of scam, and there's a lot of different types of scams. So it's in effect the ability to share, then the obligation to also consume that data as an institution across multiple sectors, and then I think having specific timeframes by which to implement those. And I think all of those things, speed, cooperation, sophistication and investment, is going to reduce scams even further. And as I said, it's a huge focus across the entire banking industry. And look, we're having a lot of bilateral engagements. I think yesterday publicly we're talking about one of the partnerships we've done with Telstra. We've worked with several telcos. Some of the information that we're sharing, there's some indicators in the context of the particular, I won't describe them because that would be helpful to scammers, but there's some specific things that happen on a phone and duration and other factors. And so by working together in that particular case, we've been able to reduce scams. We've had some engagement with the technology companies. There's certainly more willingness than perhaps in the past, but as your question highlighted, speed is of the essence here.
Absolutely. Thank you. In April last year, ASIC released a report into scam prevention, detection and the response of the 4 major banks. And the report found that the overall approach to scam strategy and governance was highly variable and overall less mature than expected. And the report found that banks had inconsistent and narrow approaches to determining liability across the bank. It also found that victims are often not well supported and that the ability to detect and stop scam payments had significant gaps. So since that report came out, what actions has Commonwealth Bank taken to protect your customers from scams?
Well, I mean, specifically, I guess, almost to all of those recommendations in varying forms, but I mean, clearly this issue and the losses or impact to customers on a monthly basis is reported all the way through to me and my team and to the board. Perhaps not on a monthly basis to the board, but regularly. We have a very specific objective. We did last financial year. We exceeded that. We have a specific objective in terms of reduction. As I said, we're investing more than $130 million, $800 million across that domain. That is more than we've ever invested. We've brought a number of technologies to market, NameCheck, which can otherwise be referred to as confirmation of payee. We've provided that to other domestic financial institutions. We've provided that to global financial institutions. We've got the ability for a customer to be able to verify that it's us calling them, for us to be able to identify that it's actually the customer we're dealing with. To give you a very simple example, we had a customer who was actually in Brisbane for work. Someone had came into a branch in Victoria and was attempting to take over their identity. The branch staff member suspected something, popped a message in the CommBank app. The genuine customer was in a meeting in Brisbane. No, I'm not in an outer Melbourne branch. Message back. Obviously, the scammer ran out, but we've got good CCTV footage. So lots of technology investments, lots of policy changes. And when I say all of that, I would see on an almost daily basis, probably daily basis, really difficult customer losses, and this is the areas where the liability is either not on a financial institution. In some aspects, I think could be greater clarity in things like the e-payments code, because, I mean, this has really emerged. And of course, we start from a position of trying to understand what our legal obligations are, and then where we're prepared to go beyond that, there has to be some principles associated with that. So we've tried to adopt much greater consistency because, as you would appreciate, not everyone reports scams. People's expectations about scam and the loss that they've suffered varies. The financial loss can be, in some cases, very, very large. And some of the digital wallet scams, less so. That's where people are purporting or get access to setting up a digital wallet on a mobile device. Investment scams. We're taking down, I think, about 50 fake CBA websites per week. To give you an example, so I mean, we've got a huge team. We're working across all of those dimensions. We've made significant improvements, and I believe there is still much more, and collectively much more, that can be done.
Thank you. I've certainly had constituents with very large amounts of money that they've had stolen, and in most of the examples they've raised, it's involved mule accounts, and obviously scammers often use genuine accounts that were opened legitimately to transfer stolen money into these mule accounts. Are you able to provide the number of mule accounts that were opened and saw traffic during the last financial year?
I couldn't off the top of my head. I could undertake to provide that to you separately. There's also, and to the extent that we can, perhaps we can try to categorise. There are different types of mule accounts. As you said, there's perhaps a simpler mule account, one that was fraudulently established by, let's say, a scammer. Now we've got biometrics, facial verification. There are others which are much harder to detect, where it can be instances where a customer is actually facilitating a scam, but they don't realise they're facilitating a scam. They might think, and this is often tied to a romance scam, they might be doing something because they believe they're in a relationship with someone, they're facilitating payments through their account and sort of entirely unknowingly supporting that scam and facilitating sort of a mule payment amount. And some of the there's degrees of shade or grey in some of those. But look, I'm certainly happy to take that on notice and see what we can provide.
Thank you. And I guess the big question is, which I don't understand, why we can't do better to identify the people that are holding these accounts when they are being used in a criminal way, given the way that, you know, a customer has to identify themselves when they establish an account. Why can't banks identify the people that are then, you know, using those accounts to transfer? Specifically
around mule accounts?
Yeah.
Well, I mean, in the same way that it's difficult to remove any, fraudulent documentation. As I said, some of the things that have certainly helped, things like facial verification, obviously integration to, identity, and particularly a digital identity solution would be helpful. I mean, I can assure you that we and all of the financial institutions put a lot of effort and cost into knowing your customer, setting up with the right identification requirements. I mean, we use biometrics to try and understand whether the pattern is representative of the customer. Their transactions, we're required to monitor transactions for a variety of different obligations, including financial crime, to screen for payments such as sanctions, to look for unusual activity. There are lots of things that we are doing in that area, and I mean, I'm sure there may be others that we could be doing, and we're looking to do that as quickly as possible. But I mean, this has been a real priority, and clearly scammers set up multiple accounts, different institutions. We've had some tremendous success at reducing scams by slowing and limiting dollars that are going out to crypto platforms, and that's not a criticism of crypto. It's just a preferred mechanism for people to particularly take money offshore. But we're also, as I was talking to Ms. Spender, I think earlier, about if you think about the 20 million payments per day, the 0.0002%, trying to find those. And I mean, in theory, we could slow every payment and not clear a payment for sort of 2 weeks. Now, you can imagine, obviously, that would have significant. And so we're always trying to get this equation right. I think this is important. It can't all be about efficiency. It has to be about sort of safety and security. Mm-hmm. But certainly digital identity and the expansion of that would be a helpful mechanism for the banking industry and others.
Mm-hmm. And what identification checks currently does the bank undertake to ensure that the people who open the accounts are still the people who are operating them?
A variety of, classic sort of 100-point check, driver's license, passport, digital sort of subscription services, as I said, sort of, the facial verification, the liveness check. They would be the main ones.
Mm-hmm. Thank you. And we've heard about cases of people selling accounts to scammers and, possibly leaving Australia after that. Do you think there could be ways that we can ensure that those who are selling the bank accounts are liable in some way for these losses?
Well, I'm sure they are liable in terms of they're certainly breaking the law. So I'll leave that sort of law enforcement. But again, your questions, and they're good ones, they're all highlighting the need for greater sharing of intelligence. And just like we see in cyber, and scams and fraud are the same, there are various destinations and areas like the dark web. There are certain platforms where information is being sold. We're obviously monitoring that. There are a variety of different sort of, cooperation agreements in place with law enforcement. Sharing information across industries, across participants can only be helpful to pick up and identify those. We're constantly monitoring in all sorts of locations to see whether any of our customers' information is being compromised, whether it's being sold, and of course if we see any evidence of that, then we would contact them, put a stop on all of their accounts.
Thank you. And so we've seen data on the amount of reimbursement that goes to customers from the period between July 2021 and 22. The big four banks paid a combined total reimbursement of approximately 21 million, and the rate varied across the individual banks but ranged from only 4% to 5%. When reimbursement occurred, the average amount refunded to the victim was around 36% of what was stolen. Do you think that's reasonable?
It's hard to provide a generic answer. I mean, I'm more familiar with the more recent data. There's some elements of this as well which don't make the comparisons easy. I mean, one way we think about it is the sort of gross exposure. What's the dollar? And I'm happy to provide you with the information. That attempted scams, what are the dollars that we prevented, which are orders of magnitude higher than the number? What do we recover? And then what do we reimburse? Now, the reimbursement in essence, will be most closely related to, I assume, financial institutions' estimates of their legal liability or where they've sought to go over and above their legal liability. There may be differing opinions about whether that's sort of representative. Again, I think this, to me, highlights there is a number of areas where there's ambiguity, and updating either existing or, as we've talked about in the context of mandatory codes, creating sort of greater clarity and specificity will help. And I mean, education's a really important part of this as well. I think it will always be the case, and it's very difficult, but if, at the end, customers need to be very wary and careful about where they're sending their money to. Now, there are some sophisticated ways that people are deceived and misled. So I'm talking about, an ordinary, but also, when sort of too good to be true investment schemes or things that look to be, on a reasonable basis, highly unlikely to be legitimate, there will always be, I guess, some individual customer accountability. But the ones that are very difficult are where, the sums are large and the person has clearly been misled, and for all the, the important and beneficial parts of Australia, Australians are trusting. And we're very conscious of that. I think it's one of the country's great strengths. Unfortunately, in a world of real-time irrevocable payments and higher degrees of trust, it also is an area or a reason why Australia is a target for scammers. We're also a wealthy country.
And what approach does Commonwealth Bank take to determining liability when someone's been scammed? What we hope is quite a comprehensive approach. So across all the different scam types, and I'm not suggesting this was all in place in the time frame that you're referencing, trying to understand the different factors, trying to also understand what our legal liability would be in those individual circumstances. And this is important just to establish a baseline. Now, of course, it's up if we would like to go beyond that, and we may in certain circumstances, but then this is something I've spoken with some consumer groups about. There has to be some principles, otherwise it leads to inconsistency. But I wouldn't seek to represent the liability regime at the moment as more than, sort of broadly immature. This area has expanded rapidly in recent years, and some of the exploitation that we've seen domestically but also globally was not, I think, contemplated certainly 5 or 10 years ago. Thank you. Thanks, Chair.
Thanks very much. Mr. Wallahan.
Thank you, Chair. Thank you, everyone, and thank you, Mr. Coman. Yesterday, the Greens political party proposed a Robin Hood tax, as a description of it, on large corporations with 40% tax on excessive profits. Given that the CBA would be high on that list, what would such a tax mean from your assessment on customers, shareholders, and our economy?
Well, I think I referred to the policy earlier as an example of insidious populism. I think it ignores, amongst other things, the beneficial elements that businesses, large and small, contribute. The contributions that they make, the people that they employ. I mean, we're obviously a reasonably large company. We employ 50,000 people. We have paid out $7.8 billion in dividends. We have more than 13 million Australian households. It also ignores a fact that it's a policy that would seem to be based upon that there's some pool of assets and capital that can just be tapped, and then whenever it may be convenient, there'll be no consequences in that. And I think, to my earlier point, it seems to me to be just fundamentally based on a false dichotomy that for a business that may be of significant scale or and as a function of that has a larger profit, that there is somehow something that is unjust about that, and that profit has been unjustifiably extracted, or there's some reason why that shouldn't be so. And as I touched on with Ms. Spender, I do believe that there is important tax reform, but these performative sort of policies and that are designed to attract attention, they lack rigour and merit, and a number of them just rely on assumptions that are just demonstrably false.
In addition to tax policy, would you agree that another relevant area would be competition policy?
Well, I mean, I think competition policy is, from our perspective, very significant, under review. I certainly don't propose to be a competition policy expert on the broader economy. I'm certainly very familiar with the ACCC's remit as it applies to financial services. I think it's obviously a very important role, and I know they fulfil it.
Thank you. Now, earlier in your statement and in some of the answers, you spoke about the two-speed economy in terms of where people are in their stage of life, particularly those in the mortgage repayment phase of their life as families. I'd like to talk about the other two-speed economy, which is geography. There's evidence that the southeast states are struggling more than the rest, and I'm a representative from Victoria. Victoria, as you know, is the second largest economy, but it saw the weakest business growth in the year 2023-24, with 152,000 businesses shutting down. We've also got several additional taxes from payroll, land tax, COVID debt levy, mental health levy. I'd like to get your observations on the two-speed economy across the Federation and Victoria in particular.
Yes, well, I mean, there are variations clearly across the economy more broadly. Certainly Victoria as a state is weaker than the other states. In some areas, not significantly. Outer suburbs of Melbourne, we can see that. You may be able to see that in some of the more detailed disclosures of our full year results. So we're certainly seeing a softer sentiment. We're seeing a slightly higher arrears, so that would be the proportion of customers that are behind on their repayments, on their home lending. I think I was with a national business earlier in the week. I know the trading conditions in Victoria are more challenging than they are certainly in New South Wales. And then it depends. I was in Townsville last week. It was actually the economic conditions there are strong. There's a really strong pipeline of investment. I found the sentiment to be positive. Obviously, in regional areas, agriculture's had a strong year. Rainfalls have been good. There's been price improvements in a number of key commodities like So it depends a little, and then some of the obviously Western Australia continues to perform well, Queensland more broadly. So at least as we would see it through, classic credit indicators, or Victoria and some of the outer suburbs of Melbourne, I think as your question suggests, are weaker than in some other areas.
So when you singled out the outer suburbs of Melbourne, are you talking about residential customers, or are you talking about business customers?
A little bit of both, but specifically I'm referencing home loan customers. I mean, I think either I and or Monique referenced the sort of 132,000 financial assistance solutions packages that we put in place. I don't have off the top of my head what that split would be in Victoria. My hypothesis would be on a representative basis, because it's not as big for us as New South Wales. It would be slightly higher, but I could certainly check that. I know certainly our view across our business customers is that trading conditions would be weaker in Victoria relative, and weaker in Melbourne than in many, probably most of the other capital cities.
And is some of that feedback, does the issue of tax come up with you?
It has not come up specifically with me.
Okay.
Yeah, I'm obviously aware of some of those changes. No, I think the... I think there's the overall sentiment, particularly some of the areas that perhaps are harder hit in higher inflation, retail discretionary, some areas of commercial property, construction has been challenged there as well. It has been nationally, but slightly higher there. And some other sort of retail, hospitality, it's not quite as strong. So I don't have a great answer, unfortunately, on a causal basis about what's leading to that, but I can see that pattern reasonably consistently.
Sure. You have the largest residential loan book. We've spoken about housing supply. I'd like to also speak about the housing mix as a home ownership versus investors. What are you seeing in terms of the split on your book between investors and first home buyers?
Yeah, so so credit growth was running, I think it was about 5.3%. Maybe investors about 3.5, 3.8, but it's starting to increase. It's becoming a more significant proportion of new finance commitments than it was certainly 6 or 12 months ago. Obviously, owner-occupier is the other side of that, so that's been relatively stable. We've certainly seen a mix. As you may appreciate, there's been fewer first home buyers, and I think greater confidence in the outlook for house prices, and I guess the broader sentiment in housing more generally has also led to a pickup in investment lending.
And in terms of the potential causes for that, have you seen any link between the rising interest rates and also the stage 3 tax cut changes in terms of the proportion of investors versus home buyers, first home buyers?
No, look, I think specifically in terms of investment, we that is more responsive, I think, overall to sort of outlook, asset prices, yields, or rents. Negative gearing obviously supports an element of that proposition. We were looking in the last week or two. We couldn't see any change on the basis of the stage 3 tax cuts in terms of sort of flow through into spend data. I think it's probably just too early at this stage.
And then finally, we'd be grateful for your observations on the issue of housing and housing supply and home ownership as a subset. Do you have observations on how the Parliament from all sides can help address the housing crisis?
It's a difficult challenge and needs to be worked on at a federal, state, local level. What do we hear consistently? Look, some aspect of it is planning, zoning. Some aspect of it is the costs of construction, labour, inputs. Now, a number of the inputs that have gone into building have started to reduce substantially. I've spoken to a number of home builders. I think most often they would say right now, and some proportion of that is a combination of the interest rate environment, the economics just don't look as good. Clearly we need more medium density. We need the infrastructure to be able to support that. We need housing of various levels of affordability, but certainly more affordable housing that's close to transport, close to where people can work, and that is going to take a whole of economy, multiple sectors. And as I touched on before, I mean, fundamentally the finance industry has probably more of an impact on the demand side, but we're certainly looking at all of our settings in terms of property developers and builders to see whether there's more risk that we could reasonably and sensibly be taking in that area. But I guess in the centre of your question, I suspect a degree of concern, which we absolutely share as we look at the pipeline. We're well below where we would need to, and it's a real issue, both economically as well as socially.
Thank you, Mr. Cormann, and thank you, Chair.
Thanks, Mr. Wallach. Hand over to Mr. Charlton. Okay, you're off mute.
Thank you. Can you hear me okay?
Yep.
Right. Thank you, Matt and Monique. I really appreciate you taking the time and being prepared to answer questions on a wide range of topics. You talked a bit with Keith about sectors where you're seeing strength and weakness across the economy. Without getting too detailed, I wanted to ask if you could give some information about whether you're seeing wage increases flowing across the economy and how that is impacting spending in different areas.
And Andrew, Dr. Charlton, you mean from, in terms of like business, maybe if I start out in terms of some of the sort of what we consider to be sort of trading conditions, some of the stronger versus weaker, and then you mean specifically what evidence? I mean, we're seeing the evidence of higher wages sort of flowing through in terms of, I don't have the data to hand, but it's one of the things that we track in our economics team as we try to get a sense of what we see as the overall wage growth in terms of as it's going through into our customers' bank accounts. There are still examples of sort of labour shortages, but clearly that has eased. But yeah, am I understanding your question correctly?
Yeah, you are. I'm trying to get a bit of a sense about whether you're seeing wages increases helping with some of the cost of living challenges that people have, and whether that's all those wage increases are supporting and across the board and in specific areas.
I mean, look, as I think we'd be representative of the wage growth across the economy. Clearly, it's higher in certain sectors, but it's at a, I guess, reasonable and certainly forecastable level. We understand and welcome those wage increases, particularly in certain sectors. I don't hear that very often as a specific concern. It was, in terms of labour shortages on the minds of businesses, that was an enormous concern. I mean, at the moment, I'd say there's a combination of just, economic outlook. Clearly, we're going through a period, other than COVID, one of the weaker levels of economic growth in the last 3 decades. As inflation gets closer to the target band, more certainty around that, and obviously the interest rate environment. I would say, and sometimes I find it somewhat incongruent, credit growth to our business bank, which goes into sort of large corporates, but all the way from sort of micro businesses, is running at double digits, which is well above the level of credit growth that we had prior to the pandemic.
What do you put that down to?
Well, it's like I said, I find it a little incongruent, but I mean, there's certainly examples where businesses have, notwithstanding the challenging situation, and I'm happy to touch on some of the sectors that I think are particularly impacted at the moment, have had some periods of good trading conditions. Their balance sheets are in good shape. I think there's some instances where there were labour shortages. They're prepared to make some additional investments. At times, some of the access to kind of capital, machinery, equipment has been harder to source and procure. That's now easier. There would also be examples there that people would be increasing sort of working capital if they're getting squeezed in some sectors. Inventory management's been really important. It's clearly many companies are needing to sort of discount to get some of the inventory that they might be holding away. Often that will increase firms' need for working capital. There's sort of a variety of different circumstances, and I guess in some areas of retail, trade, construction, commercial property, they'd be probably in some aspects of healthcare, they'd be some of our weaker. But overall, when we look at things that like hospitality, we actually would have expected more weakness. We can see that people are spending less, but patronage is still quite good. So trading conditions have definitely softened, but they're probably stronger than we would have otherwise anticipated.
We've seen a bit of data on small business insolvencies picking up, albeit from a very low level. And I guess there's an open question about how many of those insolvencies are catch up from that low level during the COVID times, and how many of them are to do with current conditions. I wonder if you had any observations on small business insolvency and some of the causes of that from the data that you look at.
Yeah, no, thank you. I mean, not with any precision, but our hypothesis is pretty similar to what you've set out. They're the highest they've been sort of a decade. There was very low levels of insolvency for a couple of years. Some aspect of that is there. We watch that very carefully. It's not really, if we look at our results, it's not really flowing through into credit losses. There are some examples, as I said, in areas like construction, there have been, higher levels of insolvency. I was touching on a question from Ms. Spender earlier about some of the work we are trying to do to refinance some of the ATO debt, which I think hopefully will be helpful to both the ATO and to our customers. I think some part of that is entirely reasonably activities to recover some of that outstanding debt with the ATO. And then I think it's just a multitude. It tends to be the smaller businesses that don't have much debt, but also don't have as much sort of financial resilience. But they're whilst every insolvency is no doubt very difficult, they're still at reasonably low levels.
Thank you. Final question. Can I come back to the issue of cash? Can you talk a little bit about your forecasting in relation to the use of cash across the economy, if you have such forecasting, or at least give us your sense of what the role of cash might be in the economy over a 5 or 10 year medium term horizon, and what are the benefits and risks that you think through in terms of the reduced use of cash?
Yeah, no, thank you. Cash will play a role, and for a smaller population, but still an important role. Clearly, the proportion of payments through cash reduced substantially, and that really accelerated through COVID. We think about, I think it's running at about 13%. I don't know what our precise forecast would be, but continuing to reduce, but perhaps not at the same level that it has in prior years. We're very focused on making sure there's an efficient and reliable transportation and distribution of cash. As I touched on earlier, we and a number of other institutions made a voluntary financial contribution to Armaguard. If you look at a business model like cash in transit, and this is globally, you're under a structural reduction in volume, and so there needs to be investment to get much greater operating efficiencies. It's highly likely that more and more financial institutions are going to pull out of cash, and so that gives us some concern, and also not that we will seek to recover all of the costs, but what's a reasonable proportion, because that could become more and more expensive over time. But look, there is certainly, I know you're not suggesting this, but there's no sort of conspiracy against cash. We respond to customers' demands. We see, clearly there's some legitimate cases, people prefer cash and they use it for either an emergency. Some customers might use it for budgeting purposes. Some may not have an alternative. That doesn't tend to be the case. There are also some other cases which perhaps are less valid for preference of cash, where greater levels of anonymity, or perhaps to escape or minimise tax.
Thank you. That's very helpful. Really appreciate your time, and I'll hand you back to the chair.
Thanks very much. I'll now hand over to Ms. Spender.
Thank you. We've talked already today about how climate change and climate targets are impacting upon your lending, but I'd also like to understand a bit more about how actual physical climate risk exposure is how you're thinking about that in terms of particularly your mortgage book, because of extreme weather events, and I note in your report issues in relation to insurance. I'm interested in you talking about what are those physical risks and how you're thinking about it, and and how you're addressing that exposure and expect it to evolve.
Thank you. Another difficult issue. Well, I mean, as part of our climate report, we've sought to categorise, and as I mentioned earlier, we think about our portfolio, our customers, and in varying degrees of physical and transition risk. Obviously, we think about how to best help and support customers through that. For some in higher risk, as an example, I know we're communicating with them in the context of trying to provide sort of practical information. Now that's easier, and the incidents, not easy, but easier for instance of, say, fire, harder in the context of flood. We intend to continue to keep reporting on that. We worry about, obviously, any dwellings that are in areas already of high physical risk. There are also, I think, examples where we're continuing to sort of zone and build in those areas. We worry about insurance and insurance coverage. The ability to actually get insurance in some of those areas, the ability to be able to afford insurance. It's not clear to me what the solution will be other than some sort of government support and intervention in some of those areas. I think in reality, people who are in lower risk areas will end up subsidising those in higher risk. I think that's sort of inevitable. But this, again, it's probably an example where there needs to be great, and I'm not suggesting there isn't, but cooperation between federal, state, financial institutions, insurers. This is going to become a more and more difficult issue over the decades. There's a degree of inevitability about that.
Okay. And to talk to a different topic, but sort of touches on you in the outset you described how different parts of the community are doing having a different experience of this current sort of economic climate, and particularly sort of younger people and the sort of stresses they're under. Certainly something I hear consistently is about HECS debt and how that impacts in terms of mortgages and ability to get mortgages. I know APRA's talking about potential this, but I'd love to understand from your bank, how do you assess HECS debt? Are there ways or opportunities to create greater opportunities for young people to get mortgages and have access to mortgages while appropriately taking into account their HECS debt?
Yeah, it's a good question. We are, primarily, as we've talked about, we think obviously that the issue is around supply, not demand. Yeah. We're conscious of not wanting to add more than we would otherwise need to demand. I do think there is a case to try to have a targeted assistance to first home buyers. We are looking at a number of things and things that are within our control and settings, not things that we're relying on the regulator for. I'm entirely comfortable with the settings that they've put in place. HECS is an example of something that we're looking at the moment. Our ordinary treatment around HECS serviceability would be based on the criteria where you have to start repaying it. It's included into the serviceability calculator, so it has an impact. It may be said that where you know and have a relationship with a customer who banks with you, you might be prepared to discount that more heavily. In most cases, people in their 20s and 30s have not peaked in terms of their income generation. Clearly, that's a factor later in life, so we could be prepared to take a more tailored approach there. There's some of the settings that we're certainly looking at. The team, I saw some work on that very recently, and we're trying to do that in a very targeted way where we believe we've got the capabilities to measure and to understand the risk, and in settings that are entirely, and appropriately inside our control and risk appetite.
Okay, thank you. I'll hand back to the Chair.
Deputy Chair.
Thank you, Chair. I'm going to break the habit of a lifetime and both read and quote The Guardian to you. This is a headline is banks, including CBA, criticised for cutting term deposit rates but not mortgage rates. Quote is, some of Australia's biggest banks are cutting interest rates for term deposits without offering equivalent deductions to mortgage holders in a sneaky strategy designed to bolster profits. Is this a fair assessment of the situation?
No, factually incorrect. We've cut both, and perhaps if I may, there's a couple of things that are important in the context of. I think everyone understands the cash rate the RBA sets, which is basically the overnight rate. Financial institutions, effectively borrow and also manage risk in a variety of other markets. One way to think about the 12-month TD rate is it's effectively the interest rate that's the average interest rate that is expected over the 12-month period. Practically what we do, I won't go into too much, no doubt, detail, but we swap via what's called the swaps market, where we can effectively manage our risk position. One of the ways we manage interest rate risk is we swap everything from fixed back into variable. So effectively, we go out into the market, we look at what the price of a 12-month swap is. When interest rates expectations change, as they did recently, and the market, notwithstanding the governor's comments, is still strongly indicating that there'll be a rate cut this calendar year. As that curve reduces, all things being equal, we'll reduce prices on both TDs and home loans. Now, I know on the TD side, I think the swaps fell about 45 basis points. I think at the 12-month mark, I think we reduced by 40. Margins are down on term deposits. We cut on fixed rate mortgages. I'd have to get the exact bands, but also fixed rate mortgages are very low in terms of the proportion of customers who are borrowing against that. So I think it's otherwise misunderstood that banks are only making pricing decisions based on the overnight cash rate. In effect, as interest rate expectations change, either up or down, that affects the price by which we're having to, effectively the input costs for us, and we transmit that. But I know from looking at the margin information, our margins on term deposits have reduced over that sort of, whatever it is, 2-month period.
Thank you very much, Chair.
Well, I was just going to ask a follow-up on that issue. I mean, I get that it's complex on both the deposit side and the mortgage side, but certainly, and this was an issue that this is an issue that's come up in a number of previous inquiries and public hearings. There has been a feeling that when the cash rate has been on an upward cycle, that the RBA might make an announcement of the cash rate, and then everybody waits to see what each of the big four banks says over the following 24 to 48 hours about how it's going to be passed through. And at various points in time, they might pass through all of it to existing customers or most of it or whatever it might be. But there's basically this, or has at least on a number of occasions been quite a high profile decision and quite soon after the cash rate is raised. And that isn't to say that your only cost of money is that, but nonetheless, it links it in the eyes of the public. But there's a feeling that when it comes to what's paid on deposits, that it's a much more lengthy and opaque process where they might go up, but through a whole series of processes and steps that are harder to follow. I mean, do you think there's any fairness in that assertion, that it's straightforward and often quite quick on the one hand, that it does flow through on the deposit side, but it's much more difficult to pin down?
Maybe I'll come to that in one moment. The other factor should have mentioned on the TDs is we were looking at this globally. Australia is the only market in the world at the moment, I'm happy to provide the facts, that the TD rate is above the cash rate. So, and separately, there was a speech done by Chris Kent from the RBA, I think about 12 months ago, that showed that the proportion of pass-through from to depositors, so more of the interest rates being passed through in a positive way than other markets. So, I mean, I say that overall to say I think the Australian market objectively and on a global basis is performing very well for customers from a pricing perspective. Specifically to your question, Chair, I am very aware and alert to the scrutiny over many, many years. And because we have a very significant number of customers with a mortgage, and the mortgage, most of those customers, are just over 80% are on a variable rate mortgage. That's typically is priced relative to the cash rate. There will be a lot of scrutiny on the decisions that we make around that product. There are obviously other factors, as you indicated, that go into that. We have certainly sought to align our decision-making processes and implementation times. There are a lot more deposit products than there are sort of loan products, but overall, I've seen that criticism before. We certainly believe we've aligned that. I have no doubt that when cash rates come down, there will be an enormous amount of scrutiny on the decisions that we make and the timing of those decisions. I think that's just a practical reality.
Yeah, I mean, look, I think this is something which has been the subject of a bit of review by the ACCC. The ACCC had a review of mortgage rates and in part was looking at the front book, back book differential, but then also a review of deposits. And I think across the two reports probably made a bit of commentary on the potential for asymmetry. I mean, ultimately, I think this report came to the conclusion, not that it's revolutionary, that more transparency and more competition is going to be ultimately the best way to lead to better outcomes.
I think to the earlier conversation, I think there's very significant evidence that there is more than ample competition. And I mean, we've paid more interest practically to depositors than we charged from mortgage customers. I mean, our net interest margin went down over the course of the year, which I guess by definition indicates that. But as I said, we're very used to and expect there to be a lot of scrutiny on those pricing decisions, and we understand that.
Now, one other question on deposits, and then I've got one question from Ms Lawrence, and then I'll hand over to Ms Spender. But just on deposits, one of the things that the ACCC inquiry uncovered, which was a little bit concerning, was that across all the banks, there were a number of complex deposit products, often with special bonuses or benefits, but that for some of those products, a very high proportion of customers weren't, after the fact, in fact, benefiting from those, partly because they were, or most often because they were breaching one or more of a number of conditions. I think that one of the recommendations out of the ACCC inquiry was that there should be more of an onus on the banks to lean in and tell customers when they were potentially going to breach, for example, the minimum holding or whatever it might be. I'm just wondering whether you've had any, whether you've changed any of your practices in light of that recommendation.
We have, and the most specific example would be our GoalSaver product, which to attract or to receive the bonus rate, which the total would be approximately 5%, you have to have deposited, in this case, $1 in the month. So we changed, so in the start of it, was actually we covered in our financial results. At the start of the year, I believe the number was 76% of customers that were getting the full bonus rate. We've we changed, enhanced, deepened, increased the level of alerting to customers. That increased that number to 86%. I think and of course that has a negative impact, but better for customers. So I couldn't speak as succinctly on every single deposit product, but certainly that's a very good example of us, being alert to that and doing everything that we can to give customers every available opportunity to make sure they're aware of the conditions of the product to qualify for the additional rate.
Would you be able to provide figures on compliance rates with conditions before and after that change?
Yeah, so that's sort of like 76, 86.
Oh, 70, sorry,
Yeah.
I missed that bit. 'Cause
I think it was 84 at the end of the half, and then it got up to 86 by 30 June. Very happy to provide that in writing.
No, that's useful. Thank you. Now, look, the question from Ms Lawrence, I think, followed on from some of the questions from Mr Laxale, and it asks, do we know why surcharges are a percentage of value for, say, debit cards rather than a flat rate like they are with EFTPOS?
I don't know that they are entirely on EFTPOS. Look, the history of surcharging, I mean, obviously there's different transaction sizes, a percentage, and because there are a number of sort of chargeback and liability mechanisms, again, I don't know that. I probably want to get a little bit more information, but I suspect it's because simply the schemes for a long period of time would say that there's a function of the risks that they and we in particular are taking, and it's appropriate to charge at a basis point versus a fix. I think EFTPOS is only fixed at the low level for small transaction sizes, but it's been some years since I've looked closely at the pricing mechanism.
We can get a question on
Sure.
notice on that. Yeah. Okay. Ms Bender.
Thank you. We talked earlier about culture, and you were talking about in relation to removing the caps on bonuses and learning the lessons. And one issue that has come up, which I think has concerned some people, is the ASIC sort of action against the banks in relation to keeping low-income Australians on high-fee accounts, which I understand the CBA, ANZ, and Westpac were involved in relation to Indigenous communities. So my question is really, how do you preserve that culture, and how do we make sure that the community does feel confidence, because it does need confidence that the banks are operating appropriately when we have those sorts of situations, and where, as I understand it, has been reported that action was only taken once ASIC sort of got involved in this.
So, I mean, the first thing I'd say is I'd de-link any reference to remuneration or culture, that specific issue. I mean, culture is obviously all-encompassing. But specifically on that review, well, and look, we provide products and services to sections of the community that other financial institutions choose not to. As I said earlier, we recognise that that's something that we've done for a long period of time. So we would have a higher proportion of Indigenous customers than any other financial institution. We have tried to, and obviously we get advice and consideration from, we have an Indigenous both leadership team internally, but also advisory group. We try to respect autonomy and choice. One of the things that, there were benefits to the product because our customers could achieve or receive access to an overdraft facility. We did have, and again, lots of sort of consideration on this particular topic. We made some changes to the product structure. So we introduced sort of a new account, which is going to be lower fee, but still will have the benefits of an overdraft. Because if you're not providing, in this case, a temporary credit facility, those customers may, and there's evidence that they would go to higher cost forms of credit. It is not, we're trying to strike the right balance there. But I mean, in essence, part of your question is, yes, we agreed with ASIC to make a, voluntary goodwill payment to customers. We hadn't, and look, it's one of the things that we do think deeply about. How do we make sure we continue to serve the community more broadly? Clearly, it is challenging to serve particularly sort of remote areas of the country. But if we don't do it, is Australia a better place if no one's providing those services? No, but we need to have, some appropriate, is there a way to defray at least some of the costs in the provision of those services? But I kind of acknowledge certainly the essence of your question, but culture is certainly always a very important topic for any company, but I think it's perhaps a tenuous or a long bow between those two.
Okay, fair enough. Thank you.
Okay. Well, thank you for appearing today. The committee secretariat will contact you in relation to any matters arising out of today's hearing. You will be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to any transcription errors. We'll now suspend proceedings and resume at 1:30 p.m. I now welcome representatives of Westpac Group. Thank you for attending today. For the benefit of Hansard, could I please ask that you each state your full name and the capacity in which you appear before the committee?
Peter Francis King, CEO and Managing Director of Westpac Banking Corporation.
Thanks.
Carolyn Francis McCann, Group Executive of Customer and Corporate Services at Westpac.
Thank you. Mr King, I remind you that although the committee does not require you to give evidence under oath, the hearings are legal proceedings of the Parliament and warrant the same respect as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. I also remind any members on video or teleconference to respect and adhere to the requirement to mute their microphone unless given the call. Mr King, I now invite you to make an opening statement if you wish.
Thank you, Chair, and I will. It's good to be here again. Today, I'll provide an update on three key areas: the outlook for the Australian economy, how customers are managing cost of living challenges, and the significant steps we're taking to battle scams. From a macro perspective, the Australian economy is proving resilient compared to global peers, just as it did during COVID. Australia's key economic indicators remain stable, and while we've seen low economic growth and slightly higher unemployment, this performance should be viewed in the context of global conditions, which are more challenging. Westpac's view is the Australian economy is well placed for a return to higher levels of growth when pressures ease, and our economics team expect interest rates to start coming down early next year. Looking at the next cycle in interest rates, the forecast is for the cash rate to settle in the low 3% range, all else being equal. From our perspective, Westpac is well positioned to support the economy. That's whether customers are seeking some assistance with cost of living challenges or if businesses are looking to grow, we're here and ready to help. The resilience of the economy is mirrored in our customer base. As an example, total loan stress has increased to 1.4%, but is lower than we expected, while more than 78% of mortgage customers are ahead on their repayments. Despite this, we recognise many Australian households are making difficult spending choices to balance their budgets. Currently, around 19,000 customers are in hardship arrangements. For context, we have more than 3.1 million customers with a debt product, and so this represents around 0.6% of customers we lend to in hardship. We're also taking additional steps to help all Westpac customers. Last September, we launched new tools in our banking app to help customers track and manage their expenses, as well as find potential savings. More than 500,000 customers are using these features every month. In May, we launched push alerts to help customers earn bonus interest on their savings, and so far, more than 150,000 customers have acted on these alerts. Finally, we continue to focus our efforts on making Australia a hard target for scammers. And I hate seeing this crime in our country, and I'd like to recognise the collective efforts of the Australian Government, regulators, banks and telcos who are working together in this fight on scams. Over the past 2 years, Westpac has invested more than $100 million in projects to help scam prevention measures, and we are seeing good results, with customer scam losses down 30% year on year. In particular, the decision to block transactions to some digital currency exchanges has been a major contributor to bringing down these losses. We've also delivered 3 significant technology upgrades to strengthen defences against scams in the last 12 months. Westpac Verify is our version of confirmation of payee. This lets customers know if the name and account details match in payments sent before any money is sent. Second is Westpac Safer Pay, And this presents customers with questions for payments we think are a high scam risk. So, for example, if someone is buying so-called investment bonds online, that would trigger the questions. Third, we are piloting Westpac SafeCall, and this is an Australian first and gives our customers a verification to prove Westpac is calling them and not a scammer. Investment scams continue to present the greatest challenge, accounting for around 50% of all customer losses, and too often Australians are getting their investment advice from ads they're finding online, including on meta platforms. Unfortunately, digital platforms and social media companies are still missing in action when it comes to the fight against scams. The Australian Financial Crime Exchange estimates that 40% of all scams originate from these platforms. And what's most shocking is that these companies are profiting from illegal ads that target Australians. These companies need to act, and if they do not, we encourage the Australian government to move decisively and quickly and regulate them. Thank you, and Carolyn and I will be happy to take your questions.
Well, thank you very much for the opening statement. Can I just go back to the initial point that you made about the overarching outlook for the economy? I think you said that it was broadly resilient. Can I just ask you to make some observations about what you're seeing in relation to consumer behaviour?
Yeah, well, in our key markets, so if we think lending markets, mortgages, business lending, we see good demand. So there's still plenty of people who can see opportunity and want to borrow. So that would be the first lens I would give you. We're also seeing people save. Our economics team believe the majority of the tax cuts look like they're being saved based on the early data. So we're still seeing saving. If I look at wholesale funding markets, so that's where we borrow from wholesale debt investors, again, good opportunities there, good demand from people overseas investing in Australia, and the price is fairly consistent by historical standards. So I think we're seeing good demand, some savings being built up. Then if I look at the credit performance of the portfolio, again, so mortgages, I think, has surprised us with 78% of people being ahead on repayments. Delinquencies have gone a little bit up in mortgages, and we can discuss that later on. The other thing that we focus on is activity on our credit cards, debit cards, and I'd probably say that's gone flat, so which is in nominal terms not adjusted for growth in customers' population. Spending's gone flat. So in a per capita sense, it's probably come backwards, and I think that really reflects the fact that the consumer's doing the heavy lifting in terms of the slowdown of the economy. But I would say it is a two-speed customer base at the moment. Those who have savings are benefiting from higher interest rates. Those who have borrowed, particularly new mortgage borrowers, are feeling the brunt of the higher interest rates.
So without getting into all the details of government policy, but suffice to say that over the last 12 to 24 months, government has lent in with some targeted assistance for particular cohorts who are doing it particularly tough. And one obvious subset in the community doing it tough are people with a significant amount of debt, and that's indeed one of the design features of monetary policy. But that's just by way of context. But I'm just interested, you made the point about consumers overall. Are there different subsets or ways of cutting and splicing that you think about, for example, cohorts by age or by income, or by level of indebtedness in terms of who's doing it particularly tough at the moment?
Well, I think on the government policy, interest rates are a blunt tool, so they don't really differentiate based on circumstance. So some of the changes, I think, to help people on lower incomes, whether it be energy rebates or assistance with tax, I think has been good because they're the people doing it tough. As I said, we've got 19,000 people in hardship arrangements at the moment out of 3 million. It's a small percentage at 0.6%, but we know they're individuals and they're making hard choices. And in terms of age groups, I don't think there's any surprise. 30 to 40s typically have mortgages, so they're the people that have been most impacted by rate rises. Likewise, savings tend to be more older or later in life people, so they're benefiting from the higher rates. And so I don't think we're seeing anything different to what you would have heard from other banks.
And of the 19,000, most of those mortgages in a position where there's households are stretched? Is it mostly mortgages, or across a range of products?
Carolyn actually runs our team that looks after hardships. So Carolyn, why don't you?
Yeah, of the 19,000, about 73% of them are mortgage holders. What we are finding is that we've got about 70% of people in that group who are first time into hardship, but about 80% of them only need support for 3 months. So normally there's been some kind of life event or some reduction in income. After a 3-month period, they get back to repayments. So it's a particular group we see in mortgages, mainly owner-occupied, first home buyers, and those with higher LVRs.
And so in terms of the assistance that's provided, does it take a range of forms, or is it usually, say, a deferral in interest payments, which then would be recouped down the track when the household's in better shape?
Yeah, there's a whole range of things we can do to support customers. So, in fact, our main message is if anyone is in trouble to contact us. We've got 1,400 people in our division that are available to help with different solutions. It can be something like deferring payments. It can be reducing payments. It can be reducing interest. It can be providing some kind of short-term support from our empowerment fund, which our people are authorised to use for accommodation, emergency supplies, things to help you through a period of time. At the other end of the scale, it can be that people want support in maybe downsizing, and so we have an area that helps people if they want to sell their product. We'll help with agency fees, with refurbishment in some cases. So there's a whole different range of things that we can do, and our people are really empowered to support customers in a tailored way.
It's probably fair to say that the three large drivers are pretty consistent. So losing your job, and hopefully that's temporary, so that's why hardship's a really good approach, particularly where you change your repayments because you're bridging that gap. Sickness is another one, and then divorce. They're still the three drivers of hardship. We see a little bit more of sort of general pressure, cost of living, that type of thing in the numbers, but the three big drivers are still the big drivers. And then, I'm hopeful that we're at the top of the rate cycle, and our economics team thinks we'll start a cutting cycle in February next year. They think 1% is the range in this next cycle, so that would obviously help as well.
And, obviously you'd always like to see, and I say you as in anybody would like to see unemployment lower than where it is, but it has proved to be a more resilient labour market, all things considered, than might have been thought.
Yeah. The labour market has held up well, so the economy is creating jobs, and therefore the unemployment rate has probably outperformed what we thought. But if I look at our forecasts, we do see unemployment edging up a little bit into the sort of the high 4s, but that's still well below what we had pre-COVID. So you always got to look at these things in context. We're hopeful of the so-called soft landing being managed, and that will be good if we can maintain the robustness of the labour market while also getting inflation under control.
I'm just interested in what you see happening to net interest margins for you, and if you're in a position to make observations across the sector more broadly, over the short term, but also the medium term, just to think through some of the structural issues there.
So net interest margins have been on a long down trend over, if you take a 10, 20-year period, they've come down because of competition. And it's probably been just the last little while they've stabilised is where they've got to. What's really going on is the customer is still seeing better rates because of competition, but our return from the capital that we hold and some of our other investments is holding up the margin to be stable. So you're still seeing the impact of competition in particularly lending and lending rates and mortgages in particular. So looking backwards, I think if I think about contestability in the mortgage market, it's come in a couple of ways. Fixed rates maturing has seen a bit of competition, normal competition, customers ringing up and asking for a better rate, we want a better rate. And so how we've seen that in the mortgage market is the spread between the back and the front book's probably gone from 50 to 60 basis points down to about 8 at the moment. So that's the closest it's been that I can recall it being, and that's the RBA's data. So I think competition has really driven that. So we've got stable sort of net interest margins, but still customer competition and offset by the benefit of higher rates on, say, capital.
And what are the key factors, do you think, affecting the front book, back book differential? One contributing factor that has been suggested in previous public hearings we've had is mortgage brokers, but I'm sure there's a range of factors at play.
Well, I think we've got a competitive market. So if I think the last decade, who's been the biggest competitor into the industry, it's been Macquarie Bank. So they've been a big entrant into the mortgage market and taken share. We've still got the regional banks and offshore banks, of course, and then mortgage brokers are there as part of the distribution force. But I think we've had competition from additional players, and then we've had what mortgage brokers do is really help with the price transparency, and that has improved in the mortgage market, I think, a lot.
One of the issues that was raised in this morning's hearings was the fact that Commonwealth Bank was the first to move in relation to bonuses for some of the people in the CBA originating or processing loans. So they moved from a 50% cap to an 80% cap. I'm just wondering, has Westpac adjusted in response to that?
Yeah, I might answer that in two bits, the industry and then come back to the banks within the industry. Mm-hmm. So the original Sedgwick recommendation was to have caps in the whole industry, so across banks and mortgage brokers, and it ended up that wasn't actually what happened in the market. So mortgage brokers do not have caps, and so we've been operating, since the Royal Commission as banks at a different level of commission of variable reward for home finance mortgages to brokers. And then you're right, CBA has moved on, moving from 50% to 80%. We will finalise our thinking for next year's approach very soon, and that is a live consideration for us, because I can't be in a position where my best mortgage brokers will go to another organisation. I've got to compete within the market. But I think I'd say back on the industry and the policy, there is a lot of focus on the banks, but we only write 1 in 4 mortgages now. It used to be 1 in 2 were written through the banks if you go back 5-10 years. 3/4 of mortgages are written by mortgage brokers. If you're worried about there being an incentive issue in the market, then it really should be a standard that's applied to the whole market.
No, and I do get the argument that this needs to be looked at holistically, and that's something that, I think the committee will take on board. But I'm also conscious that when the remuneration of this sort can have a very significant impact within organisations and on broader culture. And I suppose for me it's a juncture we're at where, notwithstanding the fact that it wasn't implemented across the whole sector, I think when a major player moves, and I fully expect that some or all others are going to have to follow suit to retain staff, it just raises some questions. We're down the track a little from Hayne, and I just put a couple of quotes an ASIC spokesperson said that this change is disappointing. There is ample evidence that variable remuneration arrangements and incentive selling result in poor outcomes for consumers. And Elizabeth Sheedy, professor at Macquarie Business School, said the risk is people become short-term focused and do dodgy stuff like exploiting unsophisticated customers. So I take on board your point that we can't deal with regulatory issues in isolation, but I simply make the point that it would seem to be an issue that warrants some attention and examination, in that it can have impacts on culture.
It may, but I think Sedgwick was pretty broad-based. It wasn't just having a cap on variables, balanced scorecards, taking out incentives for hitting volume, like super incentives for volume targets. So it was broad-based. We've also implemented responsible lending controls, so the verification that we use is a level above what we used to. But that, no system's perfect. But if if the corporate regulator and some of the commentators on the industry believe that there could be issues, then I think we need to have a cap for the whole system. You can't have the smallest part of the market, which is the banks now, at a different point to the other, because I think the systemic risk is actually higher in the mortgage broker piece.
Just wanted to ask some questions around the related issues of regional and rural banks and also the branches, and Australia Post. So just interested in where the bank's thinking is at in terms of the sustainability of regional and rural branches. Like, what kinds of internal processes do you see the bank undertaking as it makes decisions on this front going forward?
Yeah, so where Westpac is we have a moratorium on regional branch closures until 2027. Mm-hmm. So that's something we put in recently. When we think about a branch, so the first thing we look at in branches is, are they being used? So that the economics drive it. So we'll look at the level of usage, the type of usage. We look at whether there's another cash ATMs available, Australia Post available, and we'll also give notice to customers about the impending change. So I think the challenge for us is the branch networks are being used less and less. We now have a team called Virtual Banking, and that is sort of the traditional phone-based call centres, but also video banking. And so we can see a lot of the non-value, if you like, non-cash transactions being done over video from your home. So that's another change that I think we will see in the way that banks service customers. Now, that doesn't fix, say, a cash issue, but certainly being able to bank from your home gives more opportunities in regional Australia. So we look at the usage, we look at the alternatives, and then we're looking overall at what's happening. It's about 96% of transactions are virtual in one way or another. So the change is happening, but we do know that there are some people that prefer to bank in person and go into branches, and we've just got to get that balance right between helping them.
Yeah, and I was going to draw attention to that broader trend which you just made reference to at the end of your answer, which is that 95% plus, and it's still rising, of transactions are digital or virtual, and that trend will undoubtedly continue. But in a lot of regional and rural communities, and indeed in my own electorate, there's this group of people, it might be elderly, cold, whatever it might be, who do rely upon a branch presence, rely upon talking to somebody. I'm just interested in, even as that proportion of people shrinks, it's still a material number of people, and banks are big enough organisations, essential services, using the term in the broader sense. There is a social licence out there that there be accessibility for all. I'm just interested in how the organisation thinks through that, and I'm just interested in what you're finding in terms of, in addition to that overall trend, are you finding some communities, some pockets do have material numbers of people who rely upon interpersonal?
It's different. So if I think about regional, so we'll always have branches. I think branches are important. They're part of our brand as a banking organisation that's been in this country for over 200 years. We've got to have representation through branches. The way they're used will change, though. I think over time there will be less cash, there will be less sort of service maintenance, if you like, because it'll increasingly be done on the phone. And so it'll be face-to-face sort of advice and counsel is how they'll end up being used. And we're at that pivot point in the transition where COVID's probably accelerated it a lot more than what we thought it would happen. And a lot of people have got used to it, but not everyone. To your point about different regions, we can go to some parts of Sydney and cash is still the predominant mechanism of exchange. That could be on the basis of the community that's there. They don't like digital transactions, they prefer cash. So we have communities like that, or we have other areas of the community that don't have access to the digital economy and they still use cash. So it's not standard depending on where you are, but I think the trend is the same, and we will have a role to help people get into the digital economy because everything is still digitising. It's not just financial services, it's the economy is. So how do we help them and how do we help them safely is something that we think about.
Might be worth mentioning co-location. The other thing we are doing, though, is co-location. So we have 627 branches around Australia, so the second largest network. But what we have found is that previously we may have had 2 branches in the one street, one being a St George, one being a Westpac. And what we have done to ensure that we can maintain that presence is kept a presence in that street but put the 2 branches together in a co-location with one single cash queue, so customers can be served regardless of the brand they're in. So that means we can maintain that footprint, and actually for a lot of our customers it's given them a lot more access points because now they can access, if they're a St George customer, all of our Westpac branches. So we have 106 of those, and that's a trend that we will continue because, as Peter said, we think the branch network is actually a really important brand presence for us as well. It's part of who we are in the community.
And then you asked about Australia Post, so I should just touch on that. Obviously, we've had a long relationship with Australia Post. They are an important distribution point with 3,500 post offices around Australia, which service, I think, 80 banks. What they've highlighted is they feel like they've got a fixed cost challenge. So the cost of premises and people in those post offices is going up. So we're one of the banks, major banks to support them, one of 3. ANZ's not currently part of that partnership, so that's important. But also there's a lot of, the major banks end up with the branches and supporting the cash. I think it is important that other or all financial services companies help cover that fixed cost for regional Australia. Now certainly I think that there's too much coverage between Australia Post and the banks in Metro. It's overbanked. I think we can move some of that resources out of Metro Australia into regional Australia. So we pay a lot of money to Australia Post. I hope that can be moved to supporting regional Australia. We don't need all the coverage that we've got in Metro Australia.
So can you just expand a bit on that fixed cost problem?
Well, if you think about Australia Post, it's got 3,500 points of presence. They're basically places, which is property costs, and people. The cost doesn't move with volume, and it's being impacted by inflation. So
right. So I guess the thing I had in the back of my mind was that, in a sense, what they'd be trying to do is to amortise that fixed cost through having more and more partnerships, in a sense, and offering more and more services. I mean, is that do you think, part of what's going to make that sustainable?
Maybe not, just for banking services, because if I look at the transaction, the increase in transactions through Australia Post over the last 5 years, it's sort of averaged 1% for us. So that says the volume is probably going sideways. Costs for them are going a different way. and so that model's not working for them, is what they've highlighted. We pay a fixed community representation fee and then a volume cost, so the revenue does go up with volume, but it's not working. We've encouraged Australia Post to share some of the information that they've got so we can work out where there's different ways to solve the problem. We're in that process at the moment.
And is your volume of transactions at Australia Post growing very slowly, in part because of that broader trend that more and more is being undertaken digitally? Is that
in part, but also, I mean, cash, I think it's about 2% of our cash transactions happen through Australia Post. So the bulk of it happens through ATMs. 2/3 of cash transactions are with ATMs. Branch networks are important. You know, there's a bit coming through the supermarkets, if you think about the supermarkets at the point of sale as well. and so it's not at a point where I think volume solves this problem. It's got to be solved in a different way.
And with Australia Post, would you say that your experience of customer interaction with Australia Post is different between metro locations and rural and regional, or is it broadly similar?
The service model is broadly the same. I think.
But engagement level, and growth rates.
I don't think there's much in the in the service level. I think small business in regional areas and cash flow is probably the area that's proved a bit harder for Australia Post than we thought through. So that's an example where we probably need more resourcing in Australia Post in regional areas, but I think it's overbanked in metro areas, so we don't necessarily need to increase it too much. I think we've got the resources in the wrong spot.
Mm-hmm. And finally, on this issue of branch closures, I'm just interested in what has been the experience of Westpac when it comes to redeploying staff internally or to other functions versus people leaving the organisation or even leaving the sector?
Generally, I haven't got the exact numbers, but generally it's been okay. So as an example, some of our people are moving into the virtual banking area where they can actually work from home in regional area and provide virtual video banking from their home to a branch or somewhere else. But of course, that doesn't work perfectly in every circumstance, so some people would leave the company.
Okay, great. No, thank you for that. I'll hand over to the Deputy Chair.
Thank you very much, Chair. I just want to start out. Can I just ask you about, you've got a product, the electric and hybrid car loan. I think it runs at I could be wrong, I think it's 5.99% per annum, and compare that to your standard car loan, which is 6.49 to 12.99%, something like that. How's that gone? Has it had a good uptake, that program?
It's been okay. I think generally I would say EVs are slower than what we thought as an uptake. I've seen reporting from other companies about rolling out charging stations. It's taking a lot longer than what they thought. So the rollout and that's because in some cases the local grids just don't have the capacity for the charging stations. So I think it's been slower than what we thought, but transition is important, we think, for the country and the economy over time. So it's an area that we've supported.
And how do you provide that lower rate? I guess just cross-subsidisation across your product lines?
We look at all our products, and that is one where we've just looked at the risk of it, and it is sharply priced.
And does it come out of, I guess, is this a product of your ESG policy, or where does a product like this come from?
Well, it is thinking about transition. So I wouldn't say ESG, but we think that climate change is a big deal. It's going to increasingly cost the population through weather events, and we need to assist the transition.
Well, forgive me for taking a bit of fun at this, but under this program, in a cost of living crisis, you offer a discount to people who can afford a Rolls-Royce, but not a discount to people who need a Hilux. That's fascinating. The people who can afford a Bentley, a Porsche, You're offering a discount to those people in a cost of living crisis where we've all discussed it, we've heard it heaps of times, people are struggling across the economy. I could go further. We're in a housing crisis where I need heaps of young kids driving around with tools rattling around in the back of a Hilux. I'd love to see some work towards them focused on. I appreciate transition's important. I got to tell you, I think you're out of touch on this one. You talk to anyone in anyone at the moment now. Cost of living is number one. This policy is a bit warped. It's very out of touch. Do you accept the premise? This is not in line with most people's concerns right now.
It's not a big product for us. I understand your point and the point you're making. Mortgages is obviously 2/3 of our loan book. It's $500 billion in lending. And if I look at the mortgage product and I think about, we have had interest rate rises in that product, but effectively three interest rate rises have been competed away. So I think we are actually, being focused on cost of living. The biggest thing is mortgages, and competition has kept down the cost of variable mortgages.
It is a strong demonstration, though, of priorities. I mean, you couldn't draw a bigger distinction between a tradie working in a Hilux and someone who can afford a Rolls Royce in this economy, and to see who Westpac is offering a discounted rate to. There's an element there that doesn't feel quite right.
I think we're doing quite a bit through our mortgage portfolio, which is big at $500 billion.
I appreciate the mortgage point,
Yeah.
and I'm happy to discuss that. But I think that on this one, I think there's a challenge there. I'll continue on the ESG thread. What's your view on future lending to fossil fuel companies, particularly gas?
Yeah. So we have a gas portfolio today. We have a pathway under our Net Zero Banking Alliance commitments, and that pathway is to reduce emissions by 21% between 2021 and 2030. The other part of that policy is a national energy security part of the policy, that if there is issues with energy security and the government asks us, we will consider finance there as well.
So you're having to be asked to step into supporting future gas?
No, we are in gas today, and we will bring that down over time. And a lot of gas companies are working on their transition plans, and we're working with them.
Right.
We've highlighted in our policy that energy security is one of the things that we would take into account. That policy is particularly important for investors. So we have an investor base that is 25% international, 75% domestic, and they've been demanding our policies on climate change and transition. And we took those plans to last year's AGM for them to give us feedback. So we want to be transparent with all our stakeholders about we think, get emissions down because of the long-term impact of climate change. But we also pointed out that energy security is important, but we would look for the government to define what that means.
Right, and forgive me, I just want to be quite specific on this. Are you, in that answer, it was looking at future I'd have to assume that your view would be future investments in gas declining is in alignment with your views, except where the government points out that you need...
Emissions declining. So yes. One of the things, so we have customers, I won't go into names, we have customers, some of which are in that area, but also investing in carbon capture and storage as an example. So that's an example where their transition plan is to offset the emissions from the gas. So that's what transition means to us. We've got to work with them. We've got to find ways to resolve it, but we also know that the nation needs energy security, and gas is important as a firming fuel.
And how do you manage that, understanding the significant challenges to carbon capture as a even vaguely credible option following the failure of the Great Artesian Basin project that Glencore was pushing through? Now, this was a project that satisfied every possible tick. Every box that needed ticking from experts told us this was a pathway to reducing our emissions. and it's failed dramatically, spectacularly. How do you protect against that? You're a bank.
That's what part of the risk of being a bank. We're in the business of managing risk. We lend money for a return and to get repaid, so we've got to manage that risk. I won't go into individual
I appreciate. No, I'm not asking for individuals. Yeah, absolutely.
But I think transition, by its nature, is the technology is not there to achieve some of the things we need to achieve. So there's risk.
Is there risk of upward pressure on gas prices if we reduce supply of gas or decrease investment in new gas projects?
Possibly, but I think the biggest driver of gas prices is what happens in the world. So we've seen the impact of the war in Ukraine and Russia, which by itself pushed energy prices in the world through the roof. That's been the big driver.
Which is a greater argument for more gas
prices.
Provision and gas sources. And look, I guess there's a question here around supply and demand basics that if we are making it more difficult for gas projects to find financing in Australia, this will have an impact on their viability and thus the supply of gas in Australia. You've pointed out, you're quite right, there is a risk. It's an upward risk on prices. Have you modelled that? Have you considered what the impact of your policy would be on gas prices?
In the scheme of things, our lending into that sector is actually quite small. A lot of the lending going into those businesses actually comes directly from the capital markets. So I think if we, if we didn't have any lending to these businesses, I think it is absorbable by the market. The bigger issue would be if the capital markets did not provide debt capital, to these companies.
I just want to touch on your opening comments on scams, which I think there's quite right a conversation around the role of social media, and if we're going to have a whole of ecosystem response to that. The framework set up, I think it's the Australian Financial Crimes Exchange. You talked about that, National Anti-Scam Centre. So this is the intel loop where banks are able to submit data into. Do you have views on that? Is this the right way to be going?
I might actually pass to Carolyn, who will just make a couple of comments on what we're seeing in social media, and then I'll come back to the whole ecosystem.
So, needless to say, we find it really distressing to see any customers who lose money. I run that division at Westpac, and we have about 500 staff just purely dedicated to scams, and we look at 30 million plus events a day. We've invested a significant amount, as Peter alluded to in his opening speech, to do a range of initiatives, and we do find they're working. We are detecting about 2/3 of scams coming through. So in the first 6 months of the year, we saved 120 million in scams. So that is working, but what we're finding is we can't be the only part of the ecosystem that's driving that change. We really need the social media platforms to step up. About 40% of frauds and scams that happen originate on social media platforms. And to use Pete's language from his opening statement, we do find them missing in action. We provide information through the AFCX, but I, having run that division, decided in addition to doing that, I would actually start posting on social media platforms where I knew that the ad or the site was a scam. So I'd personally go in and log it within their site. And I would get up every day and look, and they were still there. So they're just moving too slowly, and hence I've started writing to Meta about that as well, because we can't go this alone. We need the whole ecosystem to be fighting this crime.
Can I just briefly on that? How easy were they to find? Do you have to search for these?
Not intuitive, but you could find them to post that something was a scam. And
once you knew what you were looking for, you could find them?
Yeah, I could. And I was looking to post against the scams. So, for example, we had customers being scammed by something called Puppy Spot. So I'd drop down into that box and say this site is a scam. And it would just take weeks and weeks and weeks, and it wouldn't come down. It eventually did come down, but I'm not sure if that's because I started taking other action. So we would just like to see a code across the whole entire ecosystem, because we feel that we can do our part, and we think the banks are doing quite a lot. As far as I can see on our analysis, Australia is one of the only Western worlds where we can see scams coming down. And that's because the banks are putting an enormous amount of investment and effort into things that Pete mentioned, mentioned, things that are stopping you in-app, going slower when you're making payments, asking you questions, giving you a traffic light system as to whether or not it's green, amber or red for the payment to go through. But we're only part of the portion. 40% start on social media sites, another 20% come through telcos, through SMS messages. So we think the government idea of having a mandatory code across all of the elements of the ecosystem, whereby if it's your error, you made a mistake, then you need to fix that for that customer. But we can't go it alone.
Did you get any feedback from Meta during that process?
Once the story ran in The Australian, I received contact, we have a meeting next week. Yes.
Okay.
Yeah.
Okay. But you went through the arduous process of notifying.
Yes.
And did you get any response during that process?
I think I got one, not from the site, but when I started contacting, I got one response back about one site. But I think I mentioned 361.
That you'd done. Yeah. Wow.
So the other piece is social media companies telling people when they've clicked onto a dodgy website. Yes. So once we identify it, we think a notification to the customer to say, this is not good, would be useful. The SMS registry, we've got to be able to trust text again in the country. We need to know who's sending text. So an SMS registry is critical in the telco space, and then AFCX. We're already using in the banks to quickly share information about payments and hopefully stop the movement of them before they disappear offshore. So there's lots of things that are being worked on. I think the goal's got to be make Australia a hard place for scammers. We've got to get the number down. We just don't want to move the impact of the number somewhere else in the economy.
The one other thing that we think would be really helpful from an ability to stop these scams is the government has a document verification scheme. So the banks and other corporates pay a fee if we're trying to check that somebody's passport or somebody's Medicare card or somebody's licence is legitimate. And we think it would be great if through that MyGov app you could get a message back saying somebody is checking your credentials. We call that waterproofing. And if you get that nudge back and it's not you, we could simply send a message if we worked in conjunction with them to say, Westpac is looking at your passport. If you don't think that's you, please ring Westpac on this number. That would be really helpful.
I'm just looking at the last thing I've got is an update from July 24th. This is submissions to the AFCX portal. At this stage, it has largely been CBA who's submitted. Is that just a reflection of the early days of this project, or are you building into it?
No, I think we're live, so I'll have to maybe I'll have a look at it with you later on. I'm not quite sure.
Great. No, it should be. You don't have an issue with the the setup.
We're active members of the AFCX. I think you're talking about the intelligence loop, and they've been the first bank in there, but we're active members of the exchange.
Any early thoughts on it?
We think it's working really well. We think the banks are being very cooperative with each other in terms of if you're spotting something, we're able to share that information because it's about transactions rather than individuals. And our industry code that we've all signed up to will see what Westpac has, which is Westpac Verify, which is that green, amber, red. The industry code sees that we'll have that across the entire industry in 25. So that will be game changing. So yes, we think that interbank cooperation is working really well, and there's an element of speed that comes with that.
Yeah, no, I can see it having a great value. It definitely needs that, at least all the big four, so that we can say to the social media companies there is a unified response you're receiving. But thank you very much. Appreciate that. Chair.
Thanks, Deputy. Mr. Luxale.
Thanks, Chair. Thanks, Mr. King and Ms. McCann. I'm going to ask you the same question I opened up with CBA, just to get your version of the response. If I buy a $5 cup of coffee in cash, it costs me $5. And if I buy the same thing on my debit card, it costs me $5.08. It can cost up to that much. Why is that?
Because merchants or businesses are allowed to surcharge for electronic payments.
So you think it's just because of that?
It is.
That restriction?
Yeah.
Yeah.
So that's sort of the factual answer to your question. I think if we we sort of come back to, is the policy working, is the other thing I think about. And what we're seeing is, I don't think it's driving, the surcharging policy is not driving customer behaviour. What I think is driving customer behaviour is convenience, particularly digital wallets, and they choose between credit cards, debit cards, and EFTPOS. In your case, that's an F. What is that?
Yeah, it would be EFTPOS. Yeah, it's a multi-network card. So I've got EFTPOS
debit or
and
credit?
Debit.
Yeah, it's debit. So 1.6 was
up to one. So if I go into a blended rate, I'll get to blended rates in a second.
You've got a blended rate there. So that's an example where the policy is probably not working.
Yep.
1.6%. In fact, that's higher than our blended rate that we would charge a merchant for all. And I think that comes back to the heart of it, that we really have to think about whether surcharging is worth it, because I'm not sure it's driving the policy intent. We know the Reserve Bank's looking at it. There's no other cost in a business that people get to surcharge, if you like. What we see in our terminals, for the ones that we can see, is 90% broadly 90% of people aren't surcharging, 10% are, but we don't see some of the big merchant customers that we bank because they have their own terminals. So it's a subset of the population. But I think the question is it driving what we thought it would? And I don't think it is. It is confusing consumers, I think. And not everyone is doing it, and there's differences between merchants about whether they have a specific charge for EFTPOS, debit and credit, and then those that average it. And that typically depends on what they're choosing with the bank. So we offer customers the opportunity, if you like, for all you can eat. Here's a rate for everything. Some like that because they like to manage their cash flows that way. Others like the direct charging of give me a charge for credit versus debit versus EFTPOS. And so we've got a market at the moment that's probably too complex for the consumer to make a decision. And then the other issue we've got is some merchants are charging fees well above their costs because there's no enforcement of the rules. So I think we can all sort of have an experience. It might be getting some transport and you get a 5% charge and you go, what's that? And the taxi driver says, well, that's the bank. Well, it's not actually. Someone's configured the merchant terminal to charge that rate.
Do you think that non-enforcement's pretty rife? I mean, I know that's a question.
Oh,
for
I
the
don't think there
ACCC.
is.
Yeah.
It's pretty hard.
Yeah.
It's a distributed. How many business? We've got lots of businesses, lots of merchant terminals. It's pretty hard. I think when you're talking about 8 cents on that transaction, is it worth the confusion of what's going on? Probably not. It's another cost of business. All other costs are blended in the $5 price. So why should one particular payment mechanism be treated differently to others?
I think I'm not begrudging small businesses for having to pass on some of these costs. I just spoke to someone downstairs. Their annual cost of merchant facilities is like $12,000.
Yep.
That's a significant amount. I'm a bit worried about the blended rates, though, particularly when it comes to the use of EFTPOS debit. You mentioned you charged 1.2% as a blended rate. You just said then it didn't work. Where they use EFTPOS debit, there's a saving there that's not being realised either to the merchant or to the customer, is there? Because the cost of an EFTPOS debit surcharge is not 1.2%, is it?
No, it's lower.
Yeah,
but we're 100% enabled on least cost routing. We're take-ups in the low 40s. We probably think we get up to 60. Feels about right. Big pardon?
Why is it so low, do you think?
Businesses don't tend to worry about their banking all the time. They come in to run their business. And so we've just got to continue to push them to choose the best option for them.
Do you think it's not high because businesses are just passing it on now because it's a lot easier through do your terminals enable
possibly, but if I look at that 90-10 split, that would for the terminals we're seeing, maybe not. But I think that we're talking about, if you think the merchant terminal, we're talking about the cost to the customer that way. And then the cost from the bank, one of the things that the Reserve Bank has done a very good job on is bringing that sort of interchange rate down over time. And when I talk to the global schemes, they say they don't like Australia because it's been pushed down too low. So we are pushing it down. We can do other things, but you will have customers pick reward cards. And reward cards have, you think about a credit card, it's got rewards, it's got insurance, it's got interest-free periods. You also get access to a global network so you can use your card around the world. All those things have costs, fraud protections, of course. And so it's a fair question about what's the balance of that cost. I think the Reserve Bank does do a good job of bringing that into perspective, and they're effectively the independent arbiter on those scheme pieces.
Look, my question is specifically around EFTPOS debit, because we are unique in a way there where we do have this pretty robust domestic payment system. You're a co-owner of that, is that right?
Well, through the MPP,
the
yes.
MPP, yeah. We've got the MPP, we've got EFTPOS, we've got PayID.
Yep.
And with respect to the global scheme providers, we're not big fans of them either. Well, I'm not big fans of them either. I don't want to, if they don't like Australia, then that's okay. There's this big differential between the rate that a large business would pay. I think the RBA has it as low as 0.2% for EFTPOS, right up until 1.8, 1.9 for EFTPOS debit. Do you think that's particular? How do you explain that? Like, you've got different rates, obviously.
It's economies of scale. It's purchasing power. If you're a big supermarket chain, the value that often they have their own switches anyway, but the value that you're putting through justifies a lower price.
Is the cost to you the same, or is your cost dependent on the transaction value?
It'll depend on the relationship. But if I sort of come back to the basings, your point's right. There's a different cost to credit cards, to debit cards, to EFTPOS, but they do have different features. Is the only thing I would sort of highlight. And if you take credit cards, one of the things, why do I put on my spend through a credit card? Well, I have chargeback, fraud protections. I also have rewards, and I want to get the points. So there's a bit of what is the consumer selecting as well as the cost to the business, and that's a bit of a conundrum about who's got primacy of decision there.
Just some similar questions to the previous bank as well from earlier this morning. You seem to have an exclusive relationship with MasterCard as well. When I go to your new account screen and I go to open a new Westpac account, it automatically comes with a debit MasterCard. Is that right? Is there an arrangement between you and MasterCard to provide debit MasterCard?
Within the group, we've got a couple of brands.
Yep.
So we've got Westpac, St George, Bank of Melbourne, Bank SA.
Yep.
Typically Westpac's MasterCard, the other brand's a Visa.
Okay.
Is how it works. So we actually have
So we'll just ask for
arrangements
Westpac for this
with
time.
both of them.
Yeah, just for Westpac. So you have an arrangement with them?
Yep.
And how do they incentivise you to have MasterCard as sort of your provider for those type of products?
We went through a competitive process when we set up the arrangement. I can't remember how long ago, but it was probably 4 or 5, maybe longer years ago, and that resulted in the best provider at that point in time for that length of contract.
So there's an exchange of money, or is it per you get a cost, you get a better percentage?
It's typically
per transaction?
interchange. There's typically interchange,
Yep.
and then there's typically a request. We can get some money back, but we have to invest it back in the business on certain initiatives that benefit that business.
So MasterCard gave you a better interchange fee than others, without giving away your secrets, but that's how it would work. You would choose, why did you choose MasterCard over others?
Well, it's not just cost. We're looking at service, the rewards proposition, the fraud proposition, the cost as well, how it integrates into our systems. Do we want to have customers change cards? So there's a whole heap of things that go into a decision about a relationship with any provider, including a cards provider.
And theirs was the better
At that
proposition
time.
at the time.
At that time.
How often do you review those?
I knew you were going to ask that. I think it's up in 2 or 3 years. It was quite a long contract.
Yeah, okay. I want to understand why, with your LCR so low of the big four, the take-up, 41%, I think others it ranges from 41 to 52%. So my understanding with LCR so low, if a consumer taps with a multi-network, MasterCard, debit and EFTPOS, if LCR is off, it goes through the MasterCard debit function.
I think that's right.
Yeah.
I think that's in the set for the wallet and the card.
Yeah.
Depends how the wallet and the card are working.
That's right. In most instances, what given that you co-own EFTPOS, and from my understanding, the costs to you through EFTPOS in terms of that interchange fee are lower. Correct me if I'm wrong. Why isn't LCR enabled for all your merchants, the ones that you have control of?
I think it's coming is the first thing. But if I look at EFTPOS at the moment, I don't think we've got a digital card for them. So we've got to have. We need equivalent service.
Yeah.
One that goes in an Apple Wallet type thing.
No, you can.
Not everyone though.
Right. Well, the multi-network card that I've got, do yours do that?
Yeah.
So I can choose MasterCard or EFTPOS on my digital wallet.
Right.
Yeah.
MasterCard EFTPOS. Okay.
You don't offer that?
I'll have to check actually.
Yeah. Okay. All right. Again,
But I come back, can I come back to one point on debit cards?
Sorry?
Debit cards are a global system.
Yep.
Yeah. And you get the protections, including fraud and whatnot, through MasterCard. EFTPOS, you're right, is cheaper and it's domestic and it's not global. So that's how we're thinking about it. And we'll look at the routing and how it works from an EFTPOS perspective.
Do you make more or less revenue and interchange from EFTPOS debit or MasterCard debit?
More. Do we make more money out of the different cards?
Yeah.
I don't think we make a lot of money out of cards in aggregate. Actually, if the cards business for us is not a great business.
That wasn't my question.
No,
Which one do you make more of?
But we don't look at interchange as a piece. We look at the business, the whole economics of the business, and it's not a great business to be in at the moment.
Providing cards?
Yeah.
Right. Does it cost you more per dollar to transact in cash or digitally?
Different per dollar.
I get they're different, but which ones?
96% of our transactions are digital. We couldn't handle that through a branch network anymore. It's just too much volume. So it's not it's not an interchangeable capability. There's too much volume that goes through now. The brand, cash costs us about $350 million to handle, store, move, and whatnot, and it's embedded into the price of other products. It's not charged for as a distinct mechanism like digital payments.
And so back to you first, just to clarify, because this is what I'm trying to get down to, right? Like, why is it that for cash it's embedded? Is it a cultural thing? You mentioned regulation.
It's historical.
Is it simply just...
It's just historical.
And it's just this sort of...
You've never
for
charged
digital,
for cash.
it's a new payment. It's never... Yeah. So do you think we should move to a stage where we don't charge for digital payments, or at least have one option that's fee-free?
A free digital payment?
Yeah.
No. I don't think you're going to have investment in the network, the security and everything that you need. I don't know who will invest in the network. I think generally what we're seeing in banking over the last 10 years is cross-subsidisations are unwinding as competition comes in and picks out particular parts of the value chain. So if you have anything that's not economic, it doesn't get invested in. And I'd be really cautious about saying you want to have free payments because it'll mean there's no price signal to invest. So I think it's the other way. We want each piece to be economic in its own right, which sends the right price signals to everyone in the market.
Do you see why consumers and businesses are really agitated about this?
Yeah, I get it.
We've all switched to, not all, 75% of Australians have switched to digital. They do so for various reasons. There is a broad understanding that the digital movement of money is significantly cheaper than the non-digital alternative, yet we're being charged for it. Is that...
It looks that way, but then if you're a business, you've got someone handling the cash, you've got the security around it, you've got all those things.
Sure.
We just don't cost that. But we don't cost that and compare it against the 12,000 of digital payments. So that's what have you got a person just handling cash versus what are the charges from the bank in a digital world? That's, if you're a business, the trade-off.
Okay, thanks.
Thank you. I'll now hand over to Ms Lawrence. Yes, we can hear you.
No.
And
All
see
right,
you.
Lovely. Thank you very much. Oh, great. Excellent. I've got a range of questions. Just perhaps picking up where Mr Laxell finished, just around the surcharging. I can understand the need for business to have a sort of a floor for a minimum, small priced item to recover some of those costs. But once we start getting into high value transactions, you identified, the rationale for why there's a surcharge at all in terms of the costs associated with a digital transaction. But at what point does a percentage become kind of irrelevant? Like it's a flat cost to undertake that digital transaction. So if somebody's having to pay, 1.5% for, a $100 grocery bill or, a purchase, why 1.5% and why not just $5? Like why is it becoming as a value of the transaction if the costs are rather flat?
Yeah, so some of the input costs, so things like interchange are pretty much percentage of transaction, and what we see, not so much at the supermarket, but what we see, say, in settling for cars and houses, no one uses credit cards. They tend to do transfers, bank transfers, and so there's a point where the cards don't work because they're too expensive. You're not going to pay another 1.2% to settle your house. Not that you could on your credit card anyway, but you're not going to do it. So you'll go back to a traditional bank transfer of money, which we will do.
But if you were doing a $1,000 transaction, is the cost more for for the banks and all the other on costs that you described around insurance and whatnot? Like, is it a fair reflection of the actual cost of doing the transaction as a digital transaction, that it needs to be as a percentage of the value?
Yeah, well, rewards are generated on value. Interchange, which is sort of the scheme fee, is a better way to say it, is a percentage of the value. From our perspective...
And I appreciate it's a percentage of the value, but is it actually attributed to the cost of undertaking that transaction? Because if the ACCC are saying that it's meant to reflect the cost for the transaction, not, just because you can't charge it as a value of the transaction, like, have we got... Yeah, so have we got it right?
Maybe I'll break it into the bit and I'll put the merchant terminal in the middle, and I'll say the customers over here. That piece is supposed to recover any costs that the business incur. And then I think what you're asking me is, well, how do these costs go from the bank to the business customer? The merchant service fee is there. Things like reward points, which are often generated, are a percentage of the transaction value. From our perspective, if you take merchant businesses that take forward bookings, that you think about some type of service where you book it forward, you pay for it ahead, we have a liability if the merchant doesn't deliver the product to refund it. So it's called a chargeback. So that, again, that's a volume-based piece. Doesn't happen on every transaction, of course. So rewards, interchange, insurance will depend on what it is, but it can be the value of the transaction. So to me, I think this is where the RBA really looks at all those sort of inputs and the merchant service fees and provides input into the market. They're the best people to bring that market down, and they have over time, where Australia has very low fees for that. They effectively regulate those fees.
And we've noticed in Western Australia, for example, some of our supermarkets have, and have until recently charged a credit card transaction fee now and an EFTPOS, but now they're reducing off the EFTPOS. But to your point, and also to CommBank's comments earlier this morning, that cash is more expensive actually to process. So are you, is this a message then that businesses should increase their costs overall, or should they also be absorbing the cost of the digital transactions as they do for cash in any event? Because for consumers, it does feel like another layer of GST on top of everything else they're paying. It's another additional cost that's not reflected in the actual price.
No, I acknowledge that. I think all businesses are trying to reduce their costs because we've got lots of pressures in budgets at the moment. I think the point on cash is we as a bank see it as an expensive way to transact value. We do not charge for cash as a medium of exchange, if you like. But the regulation, the surcharging regulation from the Reserve Bank has seen digital payment costs passed on top of product costs. The old world used to be businesses used to bundle everything together, including digital payments, and work out how to recover that in their price. The theory behind the search...
I think the difficulty we're facing now is, to your point, that it's an increased cost for doing cash, and so we're seeing the closures of ATM. Westpac has closed another ATM in my community and their branch. Apart from the post office, there's no option for people, without having to travel, 20 plus kilometres to access cash. So they're left with, increasingly limited options, and yet, ultimately the consumer's paying to access their own money, because they don't have the flexibility that they once held in terms of choice.
Well, I understand that is a proportion of the community that is doing that, but 96% of transactions are now digital. So the majority of transactions are digital. What we've seen is competition driving down interest margins in banking. Competition's also driven down interchange rate, or the interchange rates over time as well. So we have seen competition driving it down, but people are looking to save money. So I understand the question. I understand the point about, is there a point that we should have a maximum cap on the costs? We can look at that. But I think...
Because you don't need to wait for the RBA, for example, to require it, do you? Like, you could actually say, small businesses are feeling the pinch, consumers are feeling the pinch, the banks are doing okay, if not great. Maybe that is a way in which we could actually pass on savings to both business and consumers.
Well, not all these decisions are ones we can take unilaterally. So the interchange rate is a card scheme set rate. It's reviewed periodic by the Reserve Bank. So that is not a decision for us. We can look at other things. We can look at rewards and routing and whatnot, and we will off the back of this review. But no, we can't make some of those decisions ourselves.
And then just to the post offices, I take your point, your share of cash services to post offices is markedly different to what we heard from CommBank this morning. But it is still, a volume of cash that's being processed by Australia Post. And in my community, we've got some lovely little heritage buildings that house a little post office and, a little supermarket attached to it, for, being able to grab a emergency meal or whatever, fruit and veg at 8 o'clock at night. So they're a real asset within our community, but they're not set up like a bank in terms of security features. And nor, I think, would that little licensed operation of Australia Post perhaps be in a position to be able to, put up the security screens and the bolts and everything necessary to provide, the protections that bank tellers have when they've got a young person working there late at night. So what sort of support are you providing to the network of post offices that are covering for the absence of banks and now ATMs as well in my community what protection and support are you providing to ensure that they can make the fit outs necessary to protect their staff?
Well, that was the point I made before about I think we're overbanked in Metro Australia and we should move those resources into regional Australia.
I'm peri-urban, just for context, so yeah. I might as well be regional and remote for the level of servicing we have in our area.
Yeah. So in the end, it's for Australia. We need to work with Australia Post. They have the responsibility to fit out those sites because it's not just for banks that they're used, obviously, and that's what we're doing through those negotiations. But I think we need to move resources out of Metro into other areas to improve them.
Make sure you include your peri-urban in your vernacular there, because we often get bundled into Metro and yet we are certainly not resourced in the same way. And I am concerned, though, about the cost shifting that the banks are pressing upon these little outlets, where they may not be able to get the volume to recoup the cost of any investment in their buildings. As I say, many of them are just little old heritage buildings as well. So in terms of the servicing, the cash servicing arrangements that you have with Australia Post, what consideration is being given specifically around what the banks will be contributing towards that cost shift?
Well, I'm not sure in our case. I haven't seen the data from Australia Post to justify that statement. We've got a moratorium on closing regional branches till 2027. So we haven't, and our contract's fairly new. It was signed in 2023.
Yeah, but again, I just want to make this very real for you. Mundaring, you had a Westpac branch and an ATM, both are now gone. That's about 40 kilometres from the city. So that community services, services residents that extend out in towards the wheat belt. So it's not just a case of, they can drive into a metro area. For some people, that's like now becomes a 70-kilometre trip. So, I think we just got to be careful that we just don't think that this is a remote regional issue alone. It's actually in the metro, but in the peri-urban context, that we are really feeling the consequences of these decisions taken by Westpac and other banks. And for I think I read on one of the websites, that with the percentage of uptake with digital, there's only 2% that aren't, but that 2% is my mum and dad and then, many other parents who are genuinely frightened about having to move into a digital space that they're not familiar with. And we're not seeing the wraparound support to how to make sure that they don't, and those who maybe don't have the same digital literacy skills are not going to get left behind. So you can take that as a statement, but if you have any comments about efforts that you're actually making to address that, I'd appreciate it, and certainly my folks would.
Yeah, well, obviously we hear the feedback, so we'll have a look at the service in your area. That's what we will do. And then, we have the challenge that we have in branches is they are being used less in some cases, and we need to find a better way to help people like your parents, obviously. I've heard that.
And I know my parents are not alone.
And it sounds like you're a Westpac customer.
As an example.
It sounds like you're a Westpac customer, so I'll say thank you for being a customer.
And look, and I think it is, a genuine issue felt around the country about increasingly needing to use a digital interface, particularly with AI, chatbots and whatnot. To that end, where you have been, we're coming up to the 5-year anniversary with the Hayne Royal Commission. I'd like to understand a little bit more around efforts that you've put in just towards addressing, particularly around the complaints that we know have been, there's an uplift in the number of complaints made by consumers. I think we're about 100,000, is that right? In the last 6 months or so. So just would like to understand a little bit more around your efforts, or the bank's efforts, to address breaches and complaints, like if you have even numbers that you can point to where you've resolved matters to customers' satisfaction.
Yeah, so Carolyn actually runs our team that manages the complaints process. So, Caroline?
Yeah, look, I would say our complaints are coming down, but we still have too many complaints, and we've put an enormous amount of effort into a philosophy that we call spot it, log it, own it. So encouraging our staff and running programs for our staff to see the complaint in the moment. So
have you got an idea of how many complaints you've received? So this year, over the last 3 years, have you got those?
Yes, absolutely. So we had about 150,000 complaints in the first 6 months of the year. That's down about 6 or 7%. But as I said, it's still way too many.
How many of that number was resolved to the customer's satisfaction?
What I would say is about 98% of them are resolved in IDR processes, which means the customer's satisfied, they don't go any further. So 98% of them are resolved with us. They don't go to AFCA, only 2% go to AFCA. So we have the lowest number of customers across the industry going to AFCA. It's about 2,500 that go to AFCA. For us, within Westpac, we run programs so our staff understand that complaints are a second chance to win back the customer. And we have 91% of our complaints resolved at the first point of contact. So if somebody complains in the moment, we've empowered our staff to sort that. And our philosophy is we want to look after the customer and give the customer the same outcome as if they were to go all the way to AFCA. We want to give them that experience in the moment. So we're not perfect by a long shot because we've still got complaints, but we are bringing them down year on year. And we're absolutely focused on empowering our staff to err on the side of the customer.
And how do you ensure those serious complaints that are being raised by consumers, the 2% are obviously referred to AFCA, but how do we ensure that they're not hidden, that we can actually see how they're being addressed? Like what sort of transparency do you have?
Yeah, I can guarantee you they're not hidden. So anything that goes all the way to AFCA, we have what we call a Customer Outcomes Committee, which is about 3 hours every Tuesday, where we go through all of those complaints that we haven't been able to resolve within a 5-day period, because that's the standard of which we aim to resolve all of our complaints within 5 days. So anything that's more complicated or difficult comes to that committee for review. We actually ask our staff to escalate if they're going to say no. So rather than, if you need approval to say yes, it's the other way around. Our philosophy is if you're going to say no, then you need to talk to your manager and we need to understand why it's a no. So in addition to that Customer Outcomes Committee, I get reporting every week. I report to the board every month. So there's an enormous amount of focus on the complaints. The other thing we try and do with them is learn from them. We want to make sure that we offer the best possible service that we can. So that's where our philosophy of spot it, log it, own it. We want every complaint recorded so that we understand what is the root cause of that complaint. And then we have people whose job is to make sure that we take the reason why there was a complaint and fix it in the product, in the service, in the way we're interacting with customers. So it's this continuous learning feedback loop so that we're making ourselves better from the complaints with the aim of reducing them over the long term.
So the Co-Compliance Monitoring Committee is also showing an increase, a 58% increase in certain breaches. ASIC's reported 19,500 breaches in the last financial year, up from 15,000 the previous year. So, in the same way, like what are you actually doing to reduce the number of breaches? What have you changed to reduce and the time it's taking to report breaches and how?
Absolutely. So breaches are a different thing to complaints. That complaints can make up breaches, but breaches are where we've done something that has been a breach of, our banking code of practice, our obligations, and we report them. In a similar way, we have a breach committee that looks at those. But we've done an enormous amount of work at Westpac, which is called our CORE program, our Customer Outcomes and Risk Excellence program, to make sure that risk is everyone's business. So we actually measure our staff on, are you seeing these mistakes and recording them as the team member as opposed to the second line risk team coming and finding them. So we have an enormous amount of things we measure.
And is there a budget line item for how much you're spending on compliance activities? What can we
Is there a
point to
budget
that?
line item? Yeah, I mean, we would be aware of what we're spending. We would be aware of what we're spending on risk, but
It's over $1 billion
Yes.
on risk and compliance.
yes. So it's
It's significant.
It's a deep part of our culture. We are really focused on our risk culture. We want our staff to speak up. We want our staff to spot these issues. We want to self-report them, and we want to fix them. We want root cause analysis, and when we do that, we don't just look at that particular breach. We do a read across and say, this has occurred in one part of our business. Could it have occurred in any other part of our business? So it's a fundamental philosophy of the way we're running the company.
Thank you. And just a couple of other questions, quick ones, perhaps in the interest of time. With scams, are you seeing an increase in scam activity as it relates to self-managed super funds?
I can't answer that as it relates to self-managed super funds. I'd have to take that on notice.
I'm not aware of it.
No, I think if it was a major piece, I would be aware of it. So I'm not seeing a huge number.
Are you seeing something in self-managed super funds?
So to me, it's been reported to me from the mid-tiers that this is an area of increasing concern where people are receiving prospectuses and they're investing in it.
I can answer that.
That's a nice return. And
yes,
then
no. So that's
we
we are seeing that's what I would call an investment scam, and we are seeing that based on dollars lost. 48% of what we're seeing is investment scams. So yes, we're very concerned about investment scams. And what we are seeing is customers might be finding it more difficult to get advice. We're seeing a particular cohort, they might be over 50, looking to retire. They're Googling and they're looking for what can I see as an investment. Something might pop up. We had one the other day, which a customer thought that they were investing in a Commonwealth Bank bond at 9%. And it was a Friday evening. They put it into their Westpac app to transfer $350,000 to this organisation for this CBA bond. Our Westpac Safer Pay, which is questions within the app, which we're deliberately designed to capture these exact things with investment scams, it triggered and it said, that's an unusual payment for you. What are you making that payment for? The customer came back and said, I'm investing. We had a drop-down box, where did you find out about your investment? They ticked Facebook. We immediately stopped it until we could talk to the customer. That was 9 o'clock on a Friday night. The customer actually, because we'd asked the questions, went to bed quite concerned, thinking, now I'm concerned. But when I looked at that CBA bond, I actually looked up and that company had an ABN. But in the morning when they woke up, they checked again because we'd asked them these questions. That ABN had only been in existence for 5 days, because you can actually register for an ABN through the ATO, and it doesn't mean that you're a legitimate organisation, but customers read into it. But when that customer rang us at 8 o'clock, we said to him, that's fine, we'd stop the payment. We weren't going to put that payment through until we spoke to you. So we saved them $350,000 and reported that scam. So investment scams are way too common. And this comes back to our point about we need the whole ecosystem working, because most of these originate via social media platforms.
And I might just add, the reduction in financial planning capacity in the country is also another issue that's built into that. Financial planning organisations, one of the benefits they bring is what's called an approved product list. So they do the due diligence on what to invest in, and that's what they allow their financial planners to invest in. So we've sort of got to, I think we've got to find a way to get financial planning at scale to Australia, so they don't do their own financial
Google
planning,
yep.
As well as what we're doing on scams and the ecosystems and who's got to do what in scams. So it's sort of a big complex issue with a number of aspects, but I don't think we've spoken about advice. I actually think we need more financial planners in the country.
Thank you. And what percentage of people borrowed at the trough interest rates of your customer base?
What percentage? We went, this is from memory, I think we went to about 40% fixed, from about 10 to 20%. But where we're at is virtually all of those low rates have now rolled off. We had our last big quarter finishing, I think, in June. So there's pretty much the fixed rates that were there are all rolled through now.
And the RBA indicated some fairly strong forecasting around consumer spend through to February. How is that correlating with what you're seeing in savings accounts?
What we're seeing in terms of spend on our debit and credit cards is pretty flat, actually. So I wouldn't describe it as strong when you adjust for inflation and sort of customer growth, population growth. We are seeing savings, but if you look at who's savings, it's sort of older people that don't have debt. So it's not a great indicator of the health because of that. We've got two economies at the moment. We've got the savers who are benefiting from higher interest rates and the borrowers who are doing the heavy lifting on slowing the economy down with the higher interest rates. And when we look at the proportion of income going to mortgage repayments, it's the highest it's been in 30 years, I think it is. So that's, they are really doing the heavy lifting.
Yeah, absolutely. Chair, I appreciate I probably pushed the time a little bit there.
No, that's fine. If you've got another one, please do.
Look, I'd just be interested to, understand a little further around your confidence in the RBA's forecasting in that regard then around the consumer spending relative to what you're seeing.
I tend to follow my economics team's forecasts and they've been generally pretty good. We're, just give you some broad numbers. If I can find the right sheet. We're expecting that's the one I want. We're expecting growth rate of 1.6% GDP for 24, 2.3% for 25, 3.5% for 26. So that's why we're a little bit more confident about the outlook. That does assume a cash rate cut of about 100 basis points and inflation back at 3% during next year, during 2025. So that's how we're seeing it. We're probably, hopefully, at the hardest part of the cycle, and we'll get those interest rate cuts early next year. But we've still got a bit of time to get through before we get there.
And I know that there's been a little bit of movement, particularly for new borrowings, for a more competitive and lower interest rate offerings. We know that there are, the laws have made it easier for people to transfer mortgages, but in practice that's not really happening. So there's still a loyalty interest rate tax incurred. What would you say to people listening who are on a rate that is not as competitive as those who are perhaps securing a new mortgage now? With the interest rates being offered, what would you say to them about moving or phoning their bank and challenging why they, to get a lower rate?
Yeah, well, the RBA data, they publish the sum of the back books, what everyone's paying today, and where a new origination's happening. It's actually the closest it's been in years. It's about 8 basis points different. So there's not a huge difference between the back book and the front book. It used to be 50 to 60 basis points. Competition's really driven that together, and we've had a lot of customers just ringing us and saying, we'll move if you don't review our rate in the last 2 years. It's slowed down now, but certainly between competition and customers being active, that back book, front book has closed up quite a bit.
Interesting. Lovely. Thank you, Chair.
No, thanks very much. Look, I'll now suspend proceedings for a short break. We'll resume at 3:20. Proceedings. Thank you for your time, and committee members, thank you. I'll now hand over to Ms. Payne.
Thank you, Chair. Thank you very much for being here and the opportunity to ask some questions today. I want to talk about scams as well. I know we've covered some of that, and in your opening statement, you've talked about the significant investment that Westpac has made into addressing scam activity and the reduction in customer losses. I did want to sort of, I have had a few constituents with quite significant losses through scams, and without going into specific details of those in this forum, both of my two constituents, part of the quite sophisticated scams that they were both targeted with were to, they were asked to deposit money into a Westpac account, which turned out to be a mule account. So I guess just the, one of the key questions that it raised is, why is it so difficult for banks to identify the owners of these accounts when customers have to present so much identification to open an account? And I understand that, accounts can be sold and etc. But can you just talk us through some of the actions that Westpac is taking to try and identify those accounts and barriers to you being able to do that?
Hand to Carolyn. I think it's a problem of misuse of accounts. So I believe I'm aware of one of the cases that you refer to, and I understand in that case that the owner of the bank account's actually been arrested. So, and broadly, I think we're dealing with 4 scenarios. The first is ID takeover, where someone takes over an ID, and biometrics has got an important part to play, I think, in resolving those issues. The second is accounts that are active, legitimate, and become illegitimate. So accounts, when people leave the country, they can often sell access to their bank accounts. So what we see as a legitimate account suddenly becomes an illegitimate account, and that's an example where we've got to pick it up as fast as we can. The third area is people are tricked into using their accounts. So again, it's a legitimate account. A romance scam is often done that way, but people give access unwillingly, or they think for the right purpose, and the account's used to move the money. And then the fourth one is where people just give access and take a payment for accessing the bank account. So there's a range of misuses in my mind that we're dealing with. It's not all people have setting up dodgy accounts. One of the other areas, before I hand to Carolyn, is companies, and Carolyn mentioned this before. Consumers think if you have an ABN number, you're a real company. Mm-hmm. All an ABN is a record that you've been registered as a company. There is no check on what you do or whether you're a legitimate business when you get an ABN. So that's an emerging area that I think we've got to focus on. But Carolyn?
Yeah, thank you, Pete. I think finding accounts that are used for illegal purposes is really challenging. We have done a range of things to try and address the problem. The first one is transaction surveillance of all inbound payments. And, I think I mentioned earlier on, we're looking at, 30 million events a day. We've got, masses of people sort of dedicated to looking at all of those things. And we're looking for authorised payments that may be unusual, unauthorised payments that are unusual. We're looking for a range of things, money that might come in and out quickly, large sums of money that come in that might not normally come in. We are really active in the Faster Bank inter-cooperation. So we've spoken about the AFCX, so making sure that when we see that information, the banks are working together really well to make sure that if money is moving from one bank to another and it's for illegal purposes, that as soon as that information is known, we act on that really, really quickly. And what we're doing at Westpac is the biometrics for onboarding. At the moment, we have it in place for anything that we might think is a high-risk area or where we see issues. By the end of this year, we'll have it biometrics everywhere. But it does go to the earlier point that I raised, which was about the document verification service. So what would be really helpful for, I think, the community more broadly is, first of all, the digital ID, but even for the document verification service that exists, if we're paying for the service to say, is that your passport, is that your Medicare card, it would be fantastic if an SMS could come into your MyGov app and say, you know, Westpac has just tapped on your passport to see that it's you. If that's not you, ring this number quickly. And I think that's the sort of thing that we've really got to drive to, because, as Pete said, you know, 2/3 of these are real accounts, or start life as real accounts. So it's quite challenging.
Thank you. And we've heard about that some of these accounts are actually sold to people who then might be leaving the country. Do you see? Do you have any thoughts on how we might be able to better, you know, identify those people?
It's hard. I mean, what we do, we're monitoring activity. When we see the change in activity, we'll pick it up. But you're not perfect. You know, as Carolyn said, we're looking for broadly one payment in every 25,000 payments is what we're looking for. So we'll find it, and we're trying to find it as quick as we can. But the inbound monitoring is probably the best thing, and that's new for us this year. Applying what we normally did to money going out of the bank to money coming into the bank as well. So we hadn't been doing that in previous years. So it's hard.
We obviously report it to the authorities when we see anything as well.
You know, people leave the country all the time. A lot of people leave the country and still customers and still operating from overseas. So it's not like everyone leaving the country sells their bank account.
Do you think there could be scope to make the original account holders liable somehow for
They're overseas.
activity?
They're out of our reach. That's the challenge. That's you know, if we look at investment scams, the biggest change we made was stop dealing with some digital currency exchanges, stop the money going out of the country. Once you're out of the country, you're beyond the reach of a lot of things. So it's hard. We just got to find it as quick as we can.
And again, coming back to these two examples of my constituents, both of them felt as well there was a lack of urgency and concern from Westpac around what happened to them, that it took time for them to be contacted. In one of the cases, the individual, like Westpac, informed the individual that they had been scammed and then provided them with an email about ways to protect themselves in future. This is a person who'd lost over $5 million. So, I mean, do you accept that, like, is this sort of the usual business as usual for Westpac, or do you, you know, aim to deal with customers better than that in situations like this?
Well, that's really disappointing to hear, and so I'd love it if offline I could get those cases from you. I'd like to think that we offer a lot better service than that, because in these circumstances, you know, our staff are trained to provide an enormous amount of empathy. These are life-changing moments for people. So really disappointed to hear that, and you know, I'll look into those cases and apologise to those customers myself. We spend an enormous amount of effort in this space, and in fact I'd like to extend an invite to all members of the committee to come to our scam centre at Parramatta. We have 500 people who are fighting this crime every single day. They are incredibly passionate about it, and in fact the most distressing thing for them is when we think we've found a scam but we can't convince the customer on the other side that it's a scam, and then they ultimately find out it is a scam. And so it's devastating for our staff when that happens. So I'd like to think that's an unusual circumstance, but I'll look into those cases.
Thank you. And we've seen data around, you know, the amount of money that is reimbursed to customers by the big banks. I quoted some data with Commonwealth Bank, which they said there's more recent data, but the data I have is that in the period from July 2021 to 2022, the big four banks paid a combined total reimbursement of approximately 21 million, and that the rate varied across the individual banks but ranged from only 4% to 5%. And where reimbursement occurred, the average amount was 36% of the amount that was stolen. So does that sound reasonable to you, or do you feel that banks could be reimbursing more of that money?
Well, our first thing is stop. So So in our first half of this year, we stopped $120 million of customer losses. That's the figure we've got to get up, and we focus very much on that. And then in terms of losses, it was 70 million that customers lost in the first half. You're right, the reimbursement of that was not high. What we do on reimbursement is we look at it case by case, and we're broadly looking for things, as Carolyn said, if we've told a customer it's a scam and they still proceed with the payment, I think that's pretty clear. We wouldn't refund that because we feel like we've done what we would do. The flip case is where we don't do what we think we need to do, then we will consider reimbursement. And we don't think there's a lot of cases where that has been the case. But I think bring it back to where we started today, having a policy and a framework for the ecosystem. What are the expectations of social media, of telcos, of the customer, of the banks, set out in a framework that we can all agree, and then we set up our businesses, and then if we don't hit it, then that's when you have the conversation about reimbursement. But I would say that from the customer's perspective, we need one ombudsman for the whole system. So someone that looks across the ecosystem and deals with all of it. We don't want four. We don't want one for social media, one for telcos, one for the banks, and someone thinking about customers. We need it together is what we need. So the reason that rate is low is when we're looking at it case by case, we feel like we've done what we said we would do. The core challenge here are these are authorised payments. So it's not an unauthorised transaction, it is an authorised transaction. That's the heart of the issue. Going back about what are we doing to harden up the controls. I think the questions that we're pumping out when people make a payment that we think is dodgy is critical. We used to run all these algorithms in the back and we'd just stop the payment, and then the customer would go, "What did you stop at?" We flipped it on its head and said, right, generate questions, pump them into the point that the payment's being made, and we're helping educate customers at the same time as if they answer in a way that we think it's clearly a scam, we stop the payment. So those type of things I think are critical. And then maybe you just want to talk about the traffic light system for...
Yeah, so the questions in app that Pete's just mentioned, we went live on that in April, and since then we've interrupted 200 transactions to ask questions, and we've stopped $195 million in the moment. Some of it would proceed, but the lion's share of it people will go, well, actually I'm going to go and check on that. The traffic light system that Pete mentioned in his opening statement, that is where we're looking to match BSBs and account names and numbers in our massive database of everything we know. We will give you an amber if we haven't seen you transfer money to that account before, and we'll give you a red traffic light if it doesn't match what we think is the right name for that account number and BSB in our system. So 15% would be new, about 5% are wrong, and so that's also helping stop in the moment. And I think that's what Pete is saying too about the right policy position has got to be to stop the crime from occurring.
Yeah, definitely agree with that. Just to change tack a little bit, last week the Sustainable Upgrades Home Loan Program's been announced, I believe.
Yes.
Yeah. So I'm just interested if you could provide an overview of that and how Westpac is implementing the program, and how this will contribute to Australia's broader environmental goals.
Yeah. So. We're pleased to work with some of the government agencies to provide that. It's broadly for existing customers who have a home loan, they can borrow more to improve their home. So that could be through energy, think batteries and solar. You could have heating and changes. So it's just about improving the housing stock in the country, but for existing customers. And if I think about transition broadly, we've got on one side we need low emission energy, electricity, and we had a good discussion on that earlier about the fossil fuel and how we transition away. But the other piece then is helping our clients become more efficient in the way that they're transitioning their business or their home. So that plays directly at the housing market and improving that from an energy perspective. So we're very pleased. Can't give you any sort of outcomes because it's still early days, but next time we're here, I'm sure we can give you an update.
Great. Thank you. Thank you, Chair.
Thanks a lot. Ms Spender.
Hello, and thank you very much for your time today. Look, I thought I would start with continuing on with some of the questions in relation to scams. I'm just interested, firstly, we had a discussion earlier with CBA about Australia's relative performance in terms of how much money Australians lose for scams compared to other countries. Some of the figures I've seen say Australians are losing about $100 each per annum, while overseas in the UK and US, sort of $35 or $45. But I just want to understand if you've got any of those figures and and then any perspectives on, the relative performance of Australia versus other countries.
Thank you for the question. On the data we see in the UK, in the UK Finance Report, UK scam cases are still up 12%. In Australia, over the same period, they're down 13%. And if we look at just Westpac on its own, we were down 32% on scam dollars lost and 37% on scam cases, just on the last 6 months on the previous corresponding period. We've done a lot of analysis in this space because it is hard. Sometimes the data is cut many different ways. But on our analysis, we can't find any other country in the Western world that is doing as well on bringing scams down as Australia is. That's
sure,
not.
I guess. So go on. Sorry, Karen.
Sorry. I was just going to say that's not to say that there's not a lot to learn from other places and we don't need to be better. But a lot of people compare what's happening in the UK. And what we see in the UK is a scam industry that's been created. There's almost a business model that's now based around how that's going. And for the dollars that are lost to scams that leave Australia, we see 45% of those dollars are linked to the UK in some way. So that's why we think that the work that we're doing to try and stop the crime is definitely the way to go, and that's why we absolutely want the whole ecosystem to stand with us again in this fight against this crime.
And I very much support the idea of an ecosystem. I'm actually, and I understand your point on the direction of travel, I'm actually trying to say, do you have any figures about the absolute numbers? Because these are the figures I've seen on absolute numbers, which would suggest that Australia actually has a bigger per capita problem, even if our direction of travel is in the right direction.
Yeah, I think the trouble is, though, with some of the data, if you look at the UK, they only report what's being reimbursed, and it's actually a more limited scheme than what you would think it would be. It's only for MPP payments. It doesn't include anything that's cash, cheque. It doesn't include investment scams. So it's a more limited pool that's being reported against our pool. So I'm just not sure that data is right. But if I look at absolute dollars, and what I can tell you, I can look at the Westpac experience, and I can tell you that the amount that we saved versus this period last year for the first 6 months was down 120 million. And if you look at the amount that we've saved year to date, if I take that into consideration, it's 180 million. Having said that, this is a real problem and we are totally focused on it. Pete reminds the company every month of his top 5 priorities, and this is in that top 5 priority.
Sure. I guess, we had CBA earlier today who said they'd reduced their scams by 50% in the last year, and you were saying 30%, both of which, they're positive numbers. Do you have any comments to say that in terms of the differences between CBA and Westpac?
Yes.
In the last year, and do we have any sort of comparison data about different banks and the levels of scams that they have?
Yes.
The scam losses.
So what I would say is that the CBA launched their version of Verify earlier than we did. For memory, I think they were in market in October of last year. We only launched in April of this year. So I imagine that would be the difference. And also they're just a bigger company, so that would also equate for the difference. But I think what will be the game changer is that under the Scam Accord that the banking industry has put together, there's 7 initiatives under that. One of them is confirmation of payee, where the whole industry will be working together for account names and BSB matches. And And that, I think, will be game-changing, and that comes into place next year.
Okay, thank you. I'll move on to a different topic. Again, this is around, just to pick up on the previous speakers' questions relating to climate. I'm interested in terms of, how Westpac is thinking about its climate risks, and particularly on its mortgage holders. With extreme weather events, obviously that is of concern to everyone. And so I'm just interested in, can you talk about how you're managing that physical risk, and, what impact you think it might have, and what steps you are taking to address, sort of emerging concerns in this area?
Yeah, I think so. So firstly, to qualify for a mortgage at most banks, including Westpac, you have to have insurance, and something that we check on settlement or refinance of a mortgage. So that's really sets the eligibility for a mortgage, and the insurance companies are really determining where you get insurance cover. So that means there's quite a bit of overlap between the risk settings of the insurance company and the mortgage portfolios of the banks. And so and what we sort of see in some of the analysis is 3 to 4% of the country can't get insurance, is some of the information that I've seen. And then within our climate disclosures, we actually include some disclosure on the physical risk in our mortgage portfolio, and we're estimating that at 3 to 4% as well. So different 3 to 4% that are in higher risk areas. What typically happens is the market, the local markets tend to price that risk through, you won't pay as much for a house that's in an area that's high risk. So you get a lower valuation, and then we obviously have LVRs and whatnot. But I think it's an appropriate question. It's a hard one because this is a long-term risk, 10, 20-year risk. It will get harder, and probably the other interplay will be between building standards and age of houses. So if you think about when you talk to the insurers, they talk about weather events being more extreme, hail being bigger, those type of things. So the impact of the storms in the future is expected to be bigger. So we'll have to lift the quality of construction to be higher than probably what it's been in the past. And that's another reason it's good that we've got support on the home loan through the government agencies to help with some of that as well.
Then, on that question of mortgages that you raised, my understanding, and correct me if I'm wrong, is that banks will check that the home has insurance at the time of its the initial mortgage, the initial settlement, but doesn't continue to check that. Is that correct?
Yeah, that's right. We've got 1.6 million mortgages, and it would be impossible to do that manually. It's just because insurance could change any day. It could be, for us, we hope that customers have insurance because it's their biggest asset. What we think would be a good solution for the country and the community is actually if we had building insurance in the consumer data right. So we need a digital way to store, to share that information, and so we know continuously about the insurance situation. With inflation, there's probably a little bit of underinsurance now because the cost of rebuilding a home is pretty high. So that's the type of benefit to the community where you could say to them, digitally, you need to look at your insurance and decide whether you've got enough because our estimates of rebuild are going to be higher. So I think that will be a good use case for CDR, not only to prove up the insurance there continuously, but to help people make better decisions on insurance as well.
Okay. I'd like to move on to lending for business. I'm conscious that I'm just interested firstly about, what do you think about the current level of lending to small and particularly small and new businesses is in the economy, particularly from the banks, but also the broader sector? Do you think it's how effective do you rate it, or how well do you think it's doing at the moment?
I think if I look at our loan portfolio, it's dominated by mortgages. We tend to be a consumer bank. It's two-thirds, broadly two-thirds mortgages, a third business, so we're skewed to consumers. Typically, the discussions we have are about both access and cost of the debt, and typically banks, because we we're required to hold so much capital, the sort of cost of debt is going to be higher for us, particularly for higher risk businesses, so cash flow lends. That doesn't say we're not doing it and we can't do more, but there's probably other more efficient mechanisms. And if you look at the US, we were in the US a few months back. It was striking how fast the private capital markets had grown, private credit markets had grown in the US, and that was because they don't apply the same capital levels as the banks do, and so that market has grown pretty significant actually. But having said that, our team did spot an opportunity for female entrepreneurs, and we put aside $500 million last year actually. If it's secured, the rate's half of what it is if it's unsecured, and so we will have probably smaller allocations to unsecured than others, and so that hopefully gives you a bit of an insight about the shape of the balance sheet and how we're thinking about it.
Yeah, I understand that. I mean, I think there's been a recent survey done on small, medium businesses, and they found that about half had actually faced difficulties trying to obtain funding, with the most common challenge being the time that it's taken to process applications. And I've heard this also sort of anecdotally, that banks don't say no, they just say keep on coming back, which is problematic for them. So, and then I look also, you mentioned very much that, you've got about sort of 2/3 mortgages and 1/3 sort of business. But like 30 years ago, we used to have about 60% business and about across the sector, and about 35% mortgages. So I'm just wondering, is this the right balance that we have here, and do we need to change in some form to enable people to access, businesses to access funding more?
Yeah, I think it's a good observation, but I think it's also the fact that, and Westpac was like that 20, 30 years ago as well. The big thing that's changed is structural reduction in interest rates and what that's done to housing prices. So the shape of the bank's balance sheet, I think, has really moved with the shape of the asset base in the country, and that's why mortgages have become such a dominant part of the system. I think that's just sort of a function of the structural step down in interest rates, and it has driven leverage up. It has driven housing prices up. That's a trend that probably would be good to reverse, but I don't think it's going to reverse quickly. It'll be a gradual thing from here. We're certainly seeing more opportunities in business at the moment than mortgages, but it's not going to move the dial in terms of that proportion between business and mortgages in the short term.
Because, I mean, some other, I think, challenging pieces, like, again, thinking particularly of the small business sector, looking at RBA data from, the last 5 years, small business lending has pretty much flatlined between 2019, even in absolute terms, while you're sort of seeing medium and large business lending actually growing. And you talk about unsecured, the sort of relatively, you talked briefly about unsecured loans. The challenge is in the small sector, there seems to be barely any lending against, any unsecured lending, which I'll be honest, I'm concerned about, particularly as young people can't afford to buy houses. So how do they put up a house to, build a business? I'm just worried that this is actually sort of structurally, we're not getting money to businesses who need to grow. Yeah,
that's a good point. But, I think what's the cutoff? I've got 3 and 5 in my mind, but I think there's... the small business loans are covered by responsible lending, and I can't remember if it's 3 or 5. I'm sorry, I'm having a mental blank.
I think we've just changed it in the new banking code
to
of
5.
practice to 5.
To 5. So responsible lending rules apply to small business up to 5 million in lending. Broadly, that means, in a sense, that you need to have a bit of a track record to access debt. So that could be a part that we need to think about how that's interplayed. In housing, it's probably a little bit easier because we're looking at the history of people's salaries, and that's pretty predictable. Small businesses will lend to, but we do have to take account of responsible lending.
Mm-hmm. Okay. Then I just wanted to jump onto just a question I asked earlier today, because I'm interested in, actually I didn't ask this question earlier today. You talk about your hardship support to customers and sort of proactively engaging with them. I'm really interested, in how much of that to proactive engagement is on mortgage holders who are, you can see are falling behind or might fall behind on debts versus, renters or other parts of the economy where they don't have a debt that they might fall behind on, but they might be actually just struggling on day-to-day bills. Just interested in the mix of your kind of attention on those two areas.
If we have a look at the things that we do, we take a range of data to see, where there might be some vulnerabilities. We think about people in hardship, people who have applied for hardship but didn't complete it. We look at people who may have dishonour fees, people who may be constantly in paying interest on their credit card, people who may have gambling spend. So we look for a range of different things to see where there might be cohorts of customers in trouble. If we have a look, we do have that, as you mentioned, the dedicated area to hardship. And so we're looking for customers who might need some assistance, and there's a broad range of things that we've provided that I went through earlier today. For your question about non-mortgage holders, what we probably look at there is credit card debt. And so we look for people who might be in persistent credit card debt. How we define that is that we look at someone who may have paid interest 10 months out of 12 months. And so if they're constantly sort of paying interest on their credit card, not getting ahead, then we will proactively contact them 4 times a year. We do it every quarter. And we just give them information about a range of different things that they could do.
I'd just add, hardship's really for borrowers. So that team really focuses on those with debt. In relation to other people that are doing it tough, our branch teams obviously deal with people every day, as do our call centres. So there'll be activities happening there. Some of the digital tools that we've rolled out in the app about helping you look at your expenses, manage your bills, those type of things. But I would come back to a point I made before about it's very hard for us to provide advice given the laws in Australia. So anything that is personal advice is pretty much no-go for banks. That's one of the practical outcomes of the laws, and I think that the community needs more financial planners, and certainly we can see some limited advice ability for the banks would be useful financial advice. So it's where we're at. I don't want to go back into full-scale financial planning. Been there, done that. But we would encourage some progress on the financial planning review.
Okay. And we'll go to a question I asked I asked the CBA this morning, which is more, sort of slightly broader, which is about economic reform, and I specifically asked about tax reform, but I'm interested in other economic reform. Obviously, you spend a lot of time talking to businesses. You have a really good sense of the economy from where you sit. Where are the sort of what are the sort of economic reform levers that you think, but we in Parliament, you can have an opportunity to give us a bit of feedback, should be focused on, as well as, some of the issues and the opportunities you've identified today?
So I'd probably, the area that we're spending a lot of time on is residential construction. I'm really worried about our ability to build enough houses. when I talk to the developers, they're pretty much focused on the premium end of the market at the moment because that's where they can make money. And affordable housing is something that doesn't make sense at the moment. So it's really important that we hit the targets to increase residential property construction. If the market's left to solve itself, I think it's going to take a long time. And so there's a couple of ideas that I would share. Firstly, everyone says to us that the development approval processes are just too long. So this is not one level of government, this is all levels of government. And why that's important is the hold cost. You buy a bit of land and you're holding it for years, that all goes into the cost of the house. So if we shorten up the development approval times, that should see the cycles go through. One of the other areas that has been suggested is some help on some of the infrastructure. So at the moment, the developers have got to pay for roads, sewers, water, electricity. It's just not working when they run their numbers. So maybe one of the things that could be looked at is some help for the local councils to actually build the infrastructure you require then to build developers. Now, you'd need that benefit to be come through in lower housing stock, but that's an idea. And then if we're looking at density, so take Sydney. Sydney really needs to go up. It can't go out because of the national parks and the Blue Mountains. Maybe stamp duty reform or stamp duty assessment on affordable housing could be something that's considered. So I think the one that worries me the most is housing. Just to give you a sense of our portfolio, our housing portfolio is about 2/3 owner-occupied, 1/3 investor. It used to be 60-40, so it's moved more towards owner-occupier. But I really think that is an area that needs considerable focus across all levels of government. Otherwise, I'm not sure how the market solves this one in the short term.
And what about the role for banks in this space? I mean, there have been suggestions out there. Could banks be more, involved in terms of funding affordable housing? Is this something that, where we can call on you to be more involved in this space?
Well, I don't think access to finance is an issue in the housing market. I genuinely believe there's plenty of access. We can debate about lending standards and responsible lending, but broadly I say the issue is not the ability to get finance. The issue is get the stock into the market. In the construction side, that's the one area where I've increased appetite, knowing that we need to build more buildings. We've relaxed. We used to have a rule that for big developments, 100% needed to be pre-sold. We've relaxed that. We don't require that anymore. So we've taken steps, but I don't get a sense that residential property is the first thing that builders want to build at the moment. They tend to want to go to infrastructure because the contracts are cost plus. So they can get a return without having risk. The residential market, the ability to get labour and the ability to get labour and materials at the price they need, it's only working for premium housing.
Okay. And finally, you touched on sort of tax in relation to stamp duty. Is there anything else in the tax space, probably slightly more broader than covering housing, but also the kind of broader sort of economy, particularly growing businesses? Any comments on that space that you think we should be bearing in mind?
I think tax reform is always hard. I think there's been many papers written about it over time. We're probably as a country too dependent on income tax. Consumption can probably do a little bit of the consumption taxes can do a little bit more harder work, and then how we think about assets and wealth and whatnot is probably another area. But good luck to the Parliament on that one.
Thank you very much. Great. Thank you very much for your time. I appreciate it.
Thanks.
Back to you, Chair.
Great. So look, I've got a couple of follow-ups. and then there'll be some questions on notice, some flagged, and there'll be some more. Look, I just wanted to go back to some of the questions Ms Spender raised around insurance, and I mean, you pointed to the fact that it's not easy for banks to be 100% clear past the point of transaction as to whether there is current insurance. We saw the publication of an Actuaries Institute paper, I think it was 4 days ago, which provided an update. So I'm not going to expect you to know it all page by page, but look, one of the key takeaways for me was, according to their measure of insurability or affordable insurance, which is it's unaffordable where it's more than 1 month gross income, the proportion of homes where insurance is now unaffordable has gone from 12% to 15%.
Yep.
So, look, at the very least, what that suggests is that there is a systemic issue out there, that it's quite likely that there are many homes which possibly had some form of insurance at the point of transaction but don't now. And I would simply say that in conjunction with that, we've seen the insurance market change quite a bit over the last 5 years, where the number of insurers willing to offer opt-out has declined. Yep. And so what had been a bit of a pragmatic halfway house for a long time isn't there anymore, which, if anything, just exacerbates that other issue in that there would be a lot of homes who wouldn't be able to get partial cover. I just put the question, I get the point about CDR, but aren't we now at a point where this is too entrenched and growing as a problem to wait for CDR, isn't it?
But I don't think we, if you think about the practicalities of knowing I'd need to do it every day, because people can cancel their policy every day. So that's why I say I think it's impossible to do.
And I'm not saying it necessarily all comes down to the banks, but my sense is it's got to be, we've got to figure out a way to deal with this.
I'm going to agree with you on that. I think, but it's got to be a digital way. We've got to get through the privacy issues so that we can share the information. So, we'll need the regulator. It's, in one sense, it's good that APRA looks after banking and insurance, so we've got one regulator there, but we may need some legislation to help us get through some of the legal aspects, particularly privacy, so we can share the data, do it in the right way. But just to put your mind at ease, we don't see a lot of loss from underinsurance in terms of the mortgage portfolios. But having said that, it's we haven't had a really big weather event for some time. But even in Lismore, it was manageable from a size of our size perspective. But I agree we need to get on with it from a systemic perspective.
I mean, and again, this is a slightly different point to the one you're raising, but it's not in Lismore, it wasn't necessarily a huge risk for your books, but we did see a lot of people who had to deal with a lot of uninsured losses.
Yep.
And so, in a sense, you're part of an ecosystem which is coming under huge strains.
Yeah, and you're right, because I think the challenge would have been they're probably insured, they got the money, but they couldn't get a new loan to rebuild in the same area because they couldn't get insurance. So that's...
But and we will, this is on an insurance set of issues, but it's relevant to banking in that.
Yeah.
But we were talking to people 2 years after the fact who are still in disputes or still in caravans, and so. But this is all relevant to the fact that.
So I agree. We need to get on with it. We might need some help from a legislative perspective to get through some of the requirements, though.
The other aspect I'm interested in your thoughts on is there's the legacy assets, residential. Assets and small businesses and more. And look, we just need as a society to figure out what to do there. But then there's still new developments at 1 in 100 risk or more. What does the bank have any thoughts on loaning in that situation?
Well, we'll come back to, if you can't get insurance, we wouldn't lend. Now that's if you're developing into an area that's high risk, the insurers are pretty good at pricing risk. They probably won't price it. So you won't be able to borrow to buy houses there.
I mean, what about
That's not a good outcome. That's my view. That's how I look at the world through my lens.
What about the situation where somebody, for example, gets opt-out insurance in that situation, knowing that that whole part of the market is coming under huge strain? I mean, that's an awkward situation, isn't it?
Yep. But that's, but I'd sort of come back to, it's got to happen continuously, because you can cancel insurance at any point, and the only way to do it at the scale we need to do it at is to find a way to do it digitally. CDR, I think, is built. From our perspective, it's safe, it's a data sharing platform. We're looking for use cases that can really make a difference. That's where I would go.
I mean, the other thing that strikes me is that a lot of the situations where we're seeing, and look, it may be that there's not much additional being approved, but we don't have much visibility, frankly. We see reports in the papers.
Yep.
But what concerns me is that 1 in 100 today could be 1 in 20 in 30 years' time. And in fact, we're increasingly seeing climate modelling where that is the best projection. And again, the nature of general insurance is that in that situation where it's at the cusp of 1 in 100 today,
yep.
like you might be able to get some kind of partial insurance today and be in compliance. But what concerns me is it's potentially putting someone in a situation where in 20 years...
We're vehemently agreeing on this. Let's do it.
Yeah. Okay. Well, I think no other committee members have signalled to me that they have any follow-ups. So thank you for appearing today. The committee secretary will contact you in relation to any matters arising out of today's hearing. You'll be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to transcription errors. I thank witnesses and also members for their time today. I declare the public hearing closed.
Thank you.
Thank you.